Welcome to Yahoo Finance Live. I'm Julie Hyman with Brad Smith. Let's get right to the three things you need to know to start your morning. First thing you need to know, First Republic Bank, that's the surviving regional bank most affected by the Silicon Valley Bank collapse fallout. It said deposits fell by over 40% in the quarter to more than $100 billion. And that's even with the $30 billion lifeline deposit from the mega banks. First Republic's profit fell by 33%. It announced it's cutting workforce and slashing executive pay. March's bank chaos forced First Republic to take out big loans from the Federal Reserve. That's one of the things that is likely to continue to weigh on its future earnings. Second thing you need to know, General Motors posted blowout first quarter earnings and raised its full year guidance as it bets on a strong road ahead. The vehicle giant had strong U.S. sales in the quarter, which helped drive its net profit nearly 20% higher and its revenue up by 11%. The company says vehicle demand remains resilient, even in the face of production challenges and a slowing economy. This report coming as GM tries to gain ground in the electric vehicle space as well. Third thing you need to know, it's so busy. We could spend the next 2 hours just reciting earnings, but here are a few highlights for you besides the ones we've mentioned. UPS said a challenging environment and changing consumer behavior crimped margins and will limit revenue this year. General Electric posted strong earnings and boosted its forecast driven by aerospace demand. And consumers are still loving Mickey D's. The fast food giant beat expectations in its latest quarter, driven by higher menu prices and as demands for its burgers boosted sales. We'll be covering all of these earnings. We've got some big interviews lined up all morning long, including PepsiCo's CFO, General Motors CFO, and the Secretary of Transportation. Stay tuned. We got much more coming your way.
Well, shares of First Republic spiraled on worse than expected earnings. Deposits declined by $72 billion during the first quarter as banking chaos spooked customers. Joining us now with his outlook on the regional bank's future is David Chiaverini, Wedbush Securities Managing Director here. David, great to have you here with us this morning. When you think about what we saw within the quarter, of course, this really accounting for that banking chaos that took place and how hard it hit First Republic. The company didn't really give time to take questions, no time to take questions really. And then at the end of it, they still have so much to answer for with regard to the $30 billion infusion that they've also received from a consortium of banks. So what are the next steps as communicated by the company to the understanding right now?
Yeah, there's a lot of unanswered questions, but the next steps really are them reducing headcount. They mentioned about 20 to 25%. I view this as kind of round one of multiple rounds that very well could occur. Attrition could also help reduce expenses, and they also mentioned about reducing their real estate footprint. Now, interestingly, they mentioned about pivoting to an originate and sell model from an originate and hold model. Now, that is more capital efficient, but it is less profitable for the company. So we did lower our EPS estimates following the print. The net interest margin, of course, is getting hammered with all of the borrowings that they had to take on to offset all of the deposits that left the bank. So our estimates are coming down, and really it's becoming a play on tangible book value, because with earnings likely to be negative for the foreseeable future, investors can really only hang their hat on a discount to tangible book value and coming up with a valuation for the company.
David, so we know that this company's profitability is really going to be challenged, as you were just outlining. Do we have to worry about First Republic's ability to survive, or is that not really in question here?
Yeah, it's not really a question now because of the unprecedented actions that the Treasury and the Federal Reserve put in place right after SVB went down. They're now enabling banks to pledge loans and securities at par and getting borrowings in return. So from a liquidity standpoint, they are just fine. And then the next thing to look at is their regulatory capital ratios. And they're holding in there as long as they don't sell their loans and they don't sell those securities and realize the losses that are embedded in their balance sheet, or realize the unrealized losses that are embedded in their balance sheet. So that gives them a long leash to survive and try and kind of wade through the difficult environment over the next several quarters.
How does that environment kind of perspire over into some of the other banks, the regional banks too. Do they look at this release, especially some of the actions that First Republic is taking specifically on the workforce reduction? Do they look at something like that and say that's, First Republic specific, or do they say, all right, this is also a time where we ourselves might need to also adjust our own headcount or operating structure?
This is a very, very much an idiosyncratic situation for First Republic. But with that said, deposit competition is becoming that much more intense. First Republic is offering CD rates at 4.95%. Let's just call it a 5% CD rate. Other banks are going to see that and say, okay, we need to increase our deposit costs as well. And then there's the competition from money market funds that are providing yields in the same neighborhood. So deposit costs are going to be going up significantly for the banking space, and that's going to weigh on net interest margins across the industry. So that would be the big read through to other banks from First Republic.
David, I do want to get back to the bigger space, but I do have one more question about First Republic, and that has to do with the conference call and the lack of questions that were able to be asked on the conference call. Was that a failure on management's part to not allow questions? Do you think that they have handled that well, and for that matter, have handled this crisis all along well?
It wasn't surprising, at least from my perspective, that they did not take Q&A. In fact, I wouldn't have been surprised if they had pre-recorded the conference call ahead of time and also not taking questions because of how unprecedented the backdrop is. They're not going to do, there's really no upside for them to take questions, especially in this environment where, their viability is at stake. So their general counsel very well may have said, let's not do a Q&A session because then they won't be in position of saying anything essentially too positive that might not turn out to be the case.
So sorry to broaden it out once again then and talk about the sector more broadly. As you said, if you're going to get this deposit competition, right, if you're going to get probably limits on profitability, not just for First Republic or some of its closest peers, but across the industry, how do you decide what to buy now? Are there good buys? Are there attractive stocks to be bought among the regionals right now?
Yeah, so our view is look at the defensive names. So the ones that do have a high level of insured deposits, those that can lock in a higher net interest margin despite the potential for, if the Fed does pivot and start reducing interest rates. So we're looking at companies like Fifth Third Bank, Regions Financial, M&T Bank, New York Community Bank. The one that we recently upgraded that has a little bit higher risk, but also higher return potential is Western Alliance, because they're showing a rebound in deposits after seeing a significant decline during the quarter. So there is a way to get exposure to the banks, but from a big picture perspective, I am expecting pressures across the industry for the next several quarters.
Yeah, certainly the reaction we saw in Western Alliance following its earnings is quite different from what we were seeing today with First Republic. David, finally, is the banking crisis over? Should people not be concerned about further sort of contagion, not just among, I don't know how much you can speak to more broadly, but even beyond the regional banks? Are there still areas that people should be watching as potentially risky?
I'd say the acute stress and panic of what transpired in early March is indeed behind us. All of the regional banks, the larger ones, reported last week, and the deposit outflows were less bad than feared. So I would say the acute stress is behind us. The next sort of potential shoe to drop is on the credit quality front, because now that the banks are reining in their lending availability and capacity, the key will be how much does the economy slow? How much do credit costs increase as borrowers are unable to, service their loans? And commercial real estate is making a lot of headlines, and deservedly so, especially in the office market. So that's what people are really going to be looking for going forward. But that's going to play out over the next 12 to 18 months, whereas the recent crisis of early March, I think, is behind us.
All right, we'll stay on top of all of that. David Chiaverini, thank you so much. Wedbush Securities Managing Director, really appreciate your perspective this morning.
Thank you.
General Motors is also out with earnings. The company raising its full-year guidance as it bets that consumers will continue to pay top dollar for cars. Yahoo Finance's editor-at-large Brian Sozzi all over these earnings. He is with us now. Really surprising quarter out from GM, I think it's safe to say.
Yeah, I think GM was a little surprised. Maybe CFO Paul Jacobson didn't. Perhaps he wasn't as surprised as I would have thought, but I think the market likes this quarter. Of course, big earnings beat from a General Motors here. Jacobson saying the economy continues to be solid and rather favorable to General Motors, seeing solid demand was his exact quote. Also, what caught my attention, and I have this on a story on the yahoofinance.com homepage now, really ramping up its EV production, looking to double the amount of EVs General Motors is producing in the second half of this year. In the first half of this year, it sees itself producing 50,000 EVs, which is a pretty good start and ultimately dependent upon them increasing battery production. To that end, on EVs, big focus for General Motors. I asked him if General Motors has seen any impact of Tesla's price cuts.
Well, you know, we've seen a lot of price activity, particularly in the EVs from all of our competitors and really throughout the world, but even here in the U.S. Our pricing strategies remain consistent, and we think that's the right way to go. Our consumers have spoken with the orders that they've placed for our EVs, and we're focused on meeting that demand across the board. Longer term, we obviously have to make sure that we're maintaining competitiveness on our cost structure and making sure that we can keep our margins strong through that EV transition. So we're focused, we're executing well, but our pricing, we feel very, very good about where it is based on the customer response we've seen.
And it has been interesting to see this quarter from General Motors because Tesla has been out consistently. They came out in the first quarter and cut prices. And what the market may be forgetting, General Motors and Ford are not responding by cutting the prices of their EVs or combustion gas-powered engine cars by 50%. I mean, not responding in that manner to what Tesla is doing. And even Tesla is not out here cutting prices by 50%. So this issue, it is always an issue, I think, in the lead up to earnings. But again, this doesn't appear to be causing broad pricing pressure through EVs and other autos that GM is selling, and I suspect you might see the same thing when Ford reports soon.
Well, they're not necessarily cutting prices, but they are saying that they're going to look to bring to market new vehicles that are below certain prices to perhaps keep customers within the GM family, talking about MSRPs below $30,000 and Trax models starting below $25,000 among this Buick Encore GX and then Envista and Chevrolet Trax and Trailblazer as well there. So even as we're looking at the battle among electric vehicle prices too, it's interesting to see even for some of the ICE legacy manufacturers, how they're just going to try and keep people within that family of products for the meantime, at least.
Oh, sorry, Brad, I was just waking up. I saw a picture of the Nissan Leaf. I can't think of a least exciting car than the electric Nissan Leaf. Oh, please, don't even show them this.
Someone who has a Leaf. I think they like it.
Please, don't even get me started. Please, just anyway, the reality, I would also point to this, buried inside this GM release. By 2030, GM expects to start producing 20% operating margins on their services business. Now, I asked Jacobson when I saw him about a month ago for around the auto show and their investor day, are they going to start charging people for heated seats? He is not ready to take it there, but I think this is a company potentially eyeing insurance, eyeing the other areas in the cockpit of the car to charge people Netflix-like services, and that could be a very lucrative revenue stream for GM.
You know what? It's funny. I'm thinking as you're talking about the Nissan Leaf. No, I mean, you're back here on set, Sauce. I got to do this for 1 second. Like, does a car need to be exciting to sell? Is a Honda Civic exciting? Is a Corolla exciting?
At these prices, perhaps they should be at $30,000 for a car. To me, it's still expensive. That's $30,000 financed probably over 5 to 7 years at 6 or 7% a pop right now in this environment. And you're suddenly now spending, what, $45,000 on a car that will completely put you to sleep in your driveway? I mean, it's awful. But nonetheless, GM is
excitement to price ratio.
But I will say GM is working on some very cool cars. I like that Cadillac Lyric, very nice.
All right. Yahoo Finance's own Brian Sozzi breaking down all things GM. We'll have more on GM later on this morning. The earnings keep rolling on this morning as well. UPS saw lower volume than anticipated in Q1, blaming a deceleration in U.S. retail sales. Revenue slumped slightly as a result, and the shipping giant predicting low volume will continue in upcoming quarters thanks to tightening economic conditions. And GE's earnings were electric. the company flexed better than expected earnings, especially in its aerospace division. The orders were up by 14% year over year, and revenue increased by 25%. General Electric has raised its full-year profit outlook on the back of strong air travel demand, predicting airplane manufacturing will be a strong performer for years to come. This is the company plans to split its power and aerospace businesses into two companies, GE Aerospace and GE Vernova. The stock is up by about 53% since the beginning of this year. And wait, there's more. McDonald's celebrating a strong first quarter. Menu price increases paired with strong customer demand saw sales increase nearly 13% for the quarter. Despite the fear of inflation, earnings show that the U.S. diner is resilient. McDonald's tends to fare well during times of economic stress as consumers flock to a more affordable dining experience.
And speaking of that not being all, we also have PepsiCo to talk about. The company not showing signs of fizzing out after the beverage giant reported net sales had climbed 10.2% in the first quarter, despite overall prices rising 16%. Pepsi also raising its full-year outlook, now expecting organic revenue to jump 8% this year. PepsiCo CFO Hugh Johnston is joining us now, and Saz is still with us as well as we do our earnings bonanza. Hugh, thanks for being a part of it. As we've been talking to you and your peers, not just in food, but in consumer products generally, about the sort of price to volume calculation. Talk to me about unit volumes and what kind of demand you are seeing on an absolute basis if you sort of try to back out the price effects.
Yeah, sure. Happy to be with you guys. Good morning. Look, volumes basically for PepsiCo were flat in the quarter. Revenue was up 14%. Food volume was down a little bit, but a big chunk of that was driven by our South African commodity business, Pioneer, which the country is experiencing some challenges with the power grid. If you back that out, food volumes were flat, beverage volumes were up slightly. I think what you see going on as much as anything is, one, obviously, we've taken some pricing to cover the inflation that we've been dealing with. Number two, as we move towards more of a unit focus, so with things like multi-packs, the big boxes that we sell of Frito-Lay products that have smaller packages in them, those packages deliver less volume than you would get out of a big bag or something like that. So you see a little bit of that going on. Same thing in beverages. As consumers move to smaller size packages, it affects volume a little bit as well. But overall, the demand for our products continues to be quite high. I mean, I think revenue is a much more reflective metric of what's happening. And with 14% revenue, obviously consumers are truly enjoying our products.
Hugh, Brian here. Good to see you as always. You've been doing this for a while, and I've been covering you and PepsiCo for a while. Are you surprised that consumers aren't out there trading down to more products or cutting back certain items? I talked to P&G's CEO early in the week, John Mueller. He told me people are using less paper towels, but they're still out there buying these paper towels at a higher price.
No, I'm not that surprised. As you said, I've been through a few cycles on this. I mean, one of the reasons defensive stocks truly do well in these types of environments is because consumers still want to have these small, simple, affordable treats and luxuries in their lives. So you may not be able to go out and get a new car. You may not be able to go out and get a really fancy piece of technology. But you can afford a bag of Doritos, or you can afford a Gatorade Zero after you work out, or you can afford an energy drink in the morning. So we tend to do pretty well through times when the consumer is more stressed on a macro basis, because we are a simple treat in your life that makes you happy. So no, I'm not terribly surprised by it.
Hugh, have you seen a material improvement in the supply chain and particularly how that has trickled through to operations, especially as we've been looking for improvements in the supply chain to further provide improvements to consumers on price as well?
Yeah, we really have. I mean, if you compare to where we were, say, 2 years ago, where we may have been operating at a 3 out of 10 on a qualitative basis, we're back almost to where we were before the pandemic. There's still occasional tightness in a particular item, a bottle or a cap or something like that. But by and large, the supply chains are almost entirely back to normal. And we see it in our customer ratings as well. The Advantage rating that we get, which is a survey of customers, we were just rated #1 again. In fact, we were rated #1 for the 7th time in a row. And the scores on service have gone up pretty dramatically as we've been able to solve these supply chain issues.
Hugh, I'm jumping around a little bit, but has the China business for PepsiCo roared back? And how do you see the trajectory of that business playing out in the back half of this year?
Yeah, I'm not sure I'd go all the way to roared back, but it's definitely gotten stronger. We grew mid-single digits in China during this past quarter. So you see it coming back, but it's coming back at a jogging pace, not at a sprinting pace is probably the best way to describe it. And I think it's going to get incrementally better each quarter. I think you'll see those growth rates continue to inch up quarter after quarter as things, just return to normal in that country.
And one of your longtime competitors, I won't mention the name, Hugh, yesterday they came out with their earnings release, and
Who could it be?
I don't know, but halfway down, they mentioned that they are using ChatGPT, and suddenly that competitor is now being viewed, at least on social media, as some form of AI play. My question to you is PepsiCo using ChatGPT, and do you see yourself as an AI play?
Well, AI is certainly broader than ChatGPT. What I would tell you is this: we are experimenting right now with AI, much like what you heard yesterday. That said, I think we also need to be responsible with how we use AI. We've actually filed with NIST a responsible AI framework, and we need to make sure that we protect employee data. We need to make sure we protect customer and consumer data. So we're using it, but we're using it in a very controlled environment so that we learn about all of this. And frankly, what we're looking for over time is making sure that we use it in a way that's sustainable and it's appropriate for everyone. I think that the potential is huge, which is why we're certainly fully involved in it, but we're trying to do this in a very, very responsible way.
Hugh, when you look across the portfolio of products right now, do you see, in terms of the growth story that PepsiCo is charting for itself going forward, what is really going to spur that next leg of growth from the C-suite's perspective right now?
Yeah, look, the growth right now is so broad that I think you're going to see it come from many, many places, not just one or two. And let me put a little bit of context on that. We're in two businesses, right? Beverages and convenient foods. Convenient foods is about a $600 billion business. Coincidentally, beverages is about the same. And the categories themselves globally are growing at about 5%. So when you have two categories that add up to $1.2 trillion, 600 billion each, and they're growing 5%, our job is to really just continue to grow those categories, try to outgrow them by a little bit. And if we do those things, we can do it US, we can do it internationally. We've got a huge opportunity to continue to grow with what we have.
Hugh, a little bit of a left turn for me, if you'll permit me for a moment. We were having a discussion yesterday about single-use plastics, which is obviously a big part of your industry. And you talked a little bit in the commentary, you and the other executives, about trying to move away from that, right? Trying to reduce water use. Where are we on that? Not just Pepsi, but sort of as the Earth. I mean, are we any closer to trying to reduce some of those single-use plastics?
Oh, I do think we're closer, to be sure. Number one, we're using lots more recycled materials, and frankly, we would love to use even more. The big challenge is supply, and the challenge on supply is getting the recycling infrastructure built around the world. The recycling infrastructure in Europe is terrific. In the U.S., it's okay, but frankly, we could use more help and do more, and we're trying to lead some efforts in that regard. Elsewhere in the world, it varies quite a bit. But I think we're making progress. We've got very specific goals out there and for 2025 and 2030, and we're making good progress on those goals. Same thing with water utilization. We've got very specific goals, and we've got very specific plans and glide paths to achieve those goals. So as a company, we view it as our responsibility to take on those challenges, and we're doing it in a very serious way.
Hugh, lastly, what is the state of PepsiCo's, I would say, emerging alcohol business?
Yeah, it's still early days on that. We're in 12 states right now. We've got licenses in a couple of dozen more states, and we'll be expanding it slowly over time. Obviously, we've got the Hard Mountain Dew product, and that product is doing very well wherever we have it. We just launched a hard tea product as well. Too early to even give any results on that. I can tell you the product is quite good. So I'd encourage you to try it and enjoy it on a weekend day.
Hey, I'm an easy sell. I go pull up one of those, Julie and Brad, and reread the PepsiCo earnings transcript. That's how my weekend goes.
One of a kind, Brian Sozzi. PepsiCo CFO Hugh Johnston, thank you so much for being here. Soz is going to be back a bit later as well. And coming up, UPS.
Thank you.
Thanks, Hugh. Coming up, UPS is slipping this morning after trimming its outlook. We'll break down that report and have the opening bell on Wall Street. That's next. We got some more movers for you now. UPS is one of them, delivering a gloomy quarter as the deceleration in U.S. retail sales resulted in lower volume than anticipated. The company is expecting volume to remain under pressure given current macro conditions. The shares are down about 6% right now. And I guess it shouldn't be that surprising that this is happening, Brad, because we know that we are seeing some pressure on goods being shipped around the country. But what's also interesting is the CEO, Carol Tomé, saying there's ongoing demand weakness in Asia as well.
Right. And this is impacting, you look across their adjusted operating profit, both for the U.S. and then additionally internationally as well. I'll start with the U.S. Operating profit dropping significantly year over year. You look at this quarter, came in at about $1.5 billion versus the $1.7 that they had seen last year. So a significant decline there on the U.S. side. The international segment, that ultimately saw a hit on the operating profit, came in at $1.1 billion last year. That was down and hit $828 million this year. And so that profit being hit at a time where this company is still going to continue to invest in driving productivity, as they're discussing about, investing in efficiency and growth initiatives, and trying to come out of this demand cycle stronger, as Carol Tomé had put it in the release that came out this morning, but at the same time, at what cost is that going to be if those dollars are being allocated elsewhere as well right now? Yeah,
I mean, you talked about operating profit, the operating profit margin falling to 11.1% from 13.6% year over year. And we keep talking about this sort of volume versus price challenge. Sure. We just showed the drop in volumes that the company had. It did have an increase in revenue per package of 4.8%, but that wasn't enough to boost the margins. So in other words, here, Unlike, say, at a PepsiCo, right, which saw an increase in volume to some extent, even as it was raising prices, UPS not seeing enough of, the volumes dropping more than expected is what screwed up the equation, for lack of a better way to explain it.
The financial targets for this year, they laid out revenue of about $97 billion is what they're expecting to see for those keeping this one on their watch list, the radar.
Yep, and there we have the opening bell here on this Tuesday morning as investors try to parse through all of these earnings. They're looking at First Republic and trying to figure out what is going on in the banking sector and how they should be assessing it, not just for banks, but sort of, is there going to be a drop in loan growth? What effect is that going to have on the U.S. economy? That has gotten a lot of attention and a lot of discussion on the macro level, even as we have the likes of a UPS, which is seen by many as a bellwether, right? It's a barometer of how much stuff is being shipped around the country and around the world, and it's seeing weakness. So you have that on the one hand, Brad. You have a lot of the other companies reporting earnings on the other hand.
Yeah.
We keep talking about mixed economic signals. By and large, earnings, I think, are coming out ahead of where people thought they would be. But if you're trying to get the read-through to economics, it still feels mixed.
Well, it might be interesting in terms of how the bellwethers have shifted too, and some of those into even the technology landscape. Right. One of those could be arguably Microsoft, and we're going to get those earnings this week. And particularly here, looking at some of the activity out of the gate here, as we're tracking the Dow Jones Industrial Average, we're flat just barely to the downside right now. Over the past 3 days, we're still net higher by about 0.2%. I'll put this on a 2-day view just so you can see kind of the activity over the course of yesterday, Monday, and then now as we're kind of getting into today's trading session, where we may continue to trend, at least as of right now, over the past 2 days, still net higher, just barely by about 0.1% there for the Dow. Nasdaq Composite, tech-heavy average. We saw tech sputtering a little bit out of the open yesterday. Nasdaq right now, you're seeing that down by about 0.5% for the tech-heavy average. The S&P 500, you're seeing that down 0.4%, and over the course of the past 2 days, down by 0.3% there. And so all of that considered, let's take a look at the 11 S&P 500 sectors here just to get a quick gander at where we may be trending, not just to start off today, but as we move on throughout the rest of the day, we're going to have to make up some declines here that we've seen out of the gate in materials. Materials down 1.25%. Energy, you're seeing that down by about 1.1% as well. However, staples, that's the lone gainer as of right now. You're seeing that flat, just barely to the upside, holding on to some green there by the hair of its chinny chin chin, as we like to call it. That's a technical term. And then additionally here, XLV, you're seeing that trickle into positive territory. Healthcare, continue to watch that as we move on throughout the rest of today's trading session. And then let's lastly take a look at some of those mega cap tech stocks. Earnings reports starting to come through. We're going to get, of course, later on today for some of these tech companies, Microsoft and Google. We're going to be watching those very closely here for Alphabet or for Google setting up their earnings here. Going into that, you're seeing a move lower, at least out of the gate this morning, flat just barely to the downside. Microsoft, though, that's down by about 0.8%, and sure to be some type of chatter around generative AI as well in search for both those companies.
Yes, maybe ChatGPT can ask questions on the, but I guess somebody would have to prompt it. It can't do it by itself.
ChatGPT, what would you ask Microsoft for when it reports earnings?
Yeah. I like it. We should do that for sure. Let's go back to some old-fashioned industrials for a moment. 3M is making moves to reduce costs and it says drive long-term improvement in margins and cash flow. As part of its restructuring, company's cutting about 6,000 jobs globally. This coming as the conglomerate also reported a beat in its latest quarter. The shares are up by about 1.8%. EPS coming in at $1.97. Analysts were looking for $1.58. Organic sales did fall by 4.9%, and this gets back to that volume question, but that is a smaller drop than analysts had been anticipating here. So, this is the second round of cuts that 3M has done. It did, 2,500 jobs earlier in the year.
Yeah, and when you think about the outlook here, taking a look at what they're projecting for the full year 2023 for 3M, they did affirm their full year expectations, but those expectations are actually for a decline here, a -6% to -2% adjusted total sales. And then additionally here, organic sales growth, decline of about 3%. So that particularly is something to keep an eye on. Then they're looking for adjusted earnings per share to come in for the full year of about $8.50 to $9 there. But again, I mean, the headline here that's at least catching some of the attention is on the restructuring that they're moving forward with. And the company saying within that release, taking those restructuring actions, trying to reduce the size of the corporate center of the company and supply chain and streamline their geographic footprint as well. So we'll see if that impacts certain regional offices in this decision and in the process of rolling back the overall headcount that they do have as well.
Yeah, while we're talking industrials, let's talk about General Electric too, because that one always tends to trend on the Yahoo Finance platform, and that company raised the low end of its full year profit forecast. In particular, profit, sales, cash flow in the first quarter all beat estimates. Aerospace demand has been improving, and so that's something the company's benefiting from. And remember, once all of the GE spinoffs and breakups and restructurings are done, aerospace is what the business is going to be as a standalone.
This has taken on so many different forms as a company with the spinoffs and the reprioritizations and restructurings that they had done even back in 2017, 2018, as you had several management changeovers take place at the C-suite level. And we're still continuing to watch this winding story of GE. However, year to date, up 53%.
Yeah, and it's back above, I believe, $100 billion, which is a milestone once again for the company in its sort of recovery and its remaking, to your point. Free cash flow is something that for a while now has been a key metric for General Electric. And in the quarter, it was $102 million. Analysts were only looking for about $732 million, give or take. And so that's obviously significantly better. Analysts were looking for an outflow, a decrease in free cash flow, pardon me. And so that was to see an inflow, to see a positive free cash flow was much better than estimated.
Let's talk about a company this morning that is perhaps music to investors' ears. Spotify saw its first quarter growth in monthly active users surpass estimates, helping boost margins with its gross margin coming in above expectations. You're taking a look at shares. That's why I'm saying it's music to their ears, perhaps. It's up by about 7% right now. And some of those key metrics that we were running through just very briefly here. Total monthly active users, 515 million monthly active users there. That is an increase sequentially of about 5%, but year over year by about 22%. And the ad-supported monthly active users, because this is going to become amazingly more interesting to track in the overall streaming landscape, whether it's just for your ears, for your music and audio, or whether it's for some of the other streaming devices that you use or services that you use for video on demand. But the ad-supported monthly active users, 317 million, and that's an increase of about 26% year over year there.
Yeah, and operating loss, the company's still losing money.
Yes. It
did not lose as much money in this quarter as analysts had anticipated, and it's done a lot to reduce costs. Like so many other companies, it has cut workers. It's getting rid of Hurdle. Remember that game where you listen to a little bit of a song and you try and guess what that song is? It's not going to have that anymore. It will not have the live audio app anymore. So it's winding down some of its operations here, trying to cut costs, which, obviously is a big theme this earnings season and has been for the past couple of months.
I'm upset. I never got to play Hurdle.
You're sad about Hurdle?
Yeah, I never got to play it.
Well, I think they're I don't think it's gone yet. We'll play it in the break. We'll play it in the break.
Done deal. Guys, coming up, General Motors is raising its full-year profit forecast after seeing revenue jump 11% in the quarter. We'll share Brian Sozzi's interview with the company's CFO next. GM gives its earnings some gas. The automaker seeing strength in its North America sales. Yahoo Finance's Brian Sozzi sat down with the GM Chief Financial Officer, Paul Jacobson, to chat about where they saw strength in the quarter. Take a listen.
Demand is remaining firm for us. Our volumes were up about 4%. Revenues were strong. Pricing still lapping some of the increases that we did last year as a result of the higher input costs and commodities. But overall, really strong execution by the team. And when you combine that with the fact that I think our $2 billion cost program is coming in at the high end of our range this year, we felt comfortable raising the guide, even in somewhat of an uncertain macro.
Halfway through your earnings slide deck presentation, Paul, you added this line, which I thought was very interesting. GM expects to sell cars that are priced $30,000 or below, a good number of them, between 2023 and 2024. How many of these cars are you selling? And was this a quarter where consumers demanded more affordability?
We really saw strength across the board. So, for example, when you look at our pickup truck franchise, we were able to grow that. But at the same time, we see a lot of customers opting for the top-of-the-line trim models across the board, whether it's in the Silverado or the Sierra, in our HD or light-duty pickups across the board. But affordability is something that we've been focused on for a long time. We've got a broad portfolio of vehicles across the board. And when you look at the Trax and some of those other programs, it's a high-quality vehicle that we've got for our consumers who may have other affordability challenges.
You really have great insight, Paul, into the economy. Of course, sitting atop the perch there at General Motors, but you've seen prior cycles. I think back to your time leading the Delta team in that CFO capacity as well. Where's the economy right now? Things from many vantage points looks like they're slowing down. Does that mean you have to become even more price sensitive and more affordable in the current quarter?
Well, we certainly have to make sure that we're watching all of the data across the board. So we spend a lot of time looking at dealer inventories, turn times on vehicles. We spend a lot of time looking at credit statistics at our GM Financial subsidiary. And so far from what we see in the data, our consumer is holding up quite nicely. And we're seeing a lot of demand, as I mentioned, even for some of the higher end trim levels as well. So it's still strong for us. We manage production to make sure that we're meeting demand. We did take a couple of down weeks of production to help balance supply with demand. And that was a strategy that I think worked really well. Our inventories were flat while our sales were up and our pricing was hanging in there. So, we're managing it as dynamically as we can, but we've also got to be focused on the longer term, which is why we're aiming for that $2 billion of cost reduction and really just beginning to help go get our structural costs in check.
I want to talk about what GM is doing, of course, in the electric vehicle space, but thinking back to the crisis in the banking space in March, what did you see from the General Motors consumer? And then as the CFO of General Motors, what were some of your early steps? Do you just go back and check the financials and shore up your debt position? Take us through that.
Well, the first thing we do is make sure that we are good stewards of our cash that we're holding on to and working with our supply chain across the board. And we didn't find any major issues when the banking crisis surfaced. We've taken some steps to be a little bit more conservative in our cash investments, but nothing material across the board. And then it's just tracking the consumer and making sure that demand is holding in there. And as you can tell from the results in the quarter, the performance was pretty consistent throughout.
As I look through these numbers, and I think one of the investor reads will ultimately be, Tesla came out here, Paul, and they were cutting prices pretty consistently through the quarter. Didn't see that impact in your quarter. Do you anticipate an impact in coming quarters if Tesla continues to stay out here and cut these prices?
Well, we've seen a lot of price activity, particularly in the EVs, from all of our competitors and really throughout the world, but even here in the U.S. Our pricing strategies remain consistent, and we think that's the right way to go. Our consumers have spoken with the orders that they've placed for our EVs, and we're focused on meeting that demand across the board. Longer term, we obviously have to make sure that we're maintaining competitiveness on our cost structure and making sure that we can keep our margins strong. strong through that EV transition. So we're focused, we're executing well, but our pricing, we feel very, very good about where it is based on the customer response we've seen.
I see what you are doing at General Motors in terms of standing up more EV production. I see what some of your larger competitors are doing. But Paul, there's a lot of smaller competitors out there in this industry. Lucid, you name it. You look overseas, NIO, Xpeng. Do you expect there to be a shakeout in the EV industry as bigger players like you and some of your competitors consolidate that position?
Well, Brian, certainly this is still a scale business, and there are a lot of advantages to being large, whether it's through the supply chain or the economies of scale of production. So, we're focused on executing our plan across the board. I think the auto industry throughout history has had large players, it's had small niche players, et cetera. So it's going to be interesting to see how it shakes out, particularly as we look at raw materials and what it takes to build out that organization. And here at GM, we've been very proactive with our partners across lithium, across cathode active materials, with Lithium Americas, with POSCO, with Livent, and we're building up that infrastructure to make sure that we can produce a lot of vehicles at volume at affordable prices.
How many EVs will you make this year or next year?
So we will make about 50,000 in the first half of this year, about double that in the second half of next year, on our way to our stated goal of getting 400,000 from 22 through the first half of 24. From then, we'll be ratcheting up to 1 million vehicles in 2025. So we're in execution mode, and there's a lot of work going on here by the team, but I feel confident in their ability to execute it.
Are those million vehicles, are those profitable sales? What does the profit profile look like?
Well, what we've said is we can get to a low to mid-single digit margin on EVs by 2025, and that's on our way to getting to parity, hopefully by the end of the decade is what we're looking at in the late part of the decade, getting to parity with ICE vehicles across the board. So a lot of scale advantages coming our way, a lot of things as we get better and better and more experienced at producing the EVs, but those are our goals long term, and I feel like we're on track to be able to hit them.
Any plans to split up that EV and the internal combustion business from an investor presentation standpoint?
Right now, we're committed to the geographic segments that we have. We talked at Investor Day back in November about we're going to put more and more EV data out as we build that up. Right now, it's not very meaningful just because of the low scale and the high infrastructure that we have right now. But as we increase utilization, produce more battery cells, and produce more EVs, we'll be very transparent with our EV profitability and the metrics we have.
That was Paul Jacobson, General Motors Chief Financial Officer, with Yahoo Finance's Brian Sozzi.
Coming up, media shakeup. Tucker Carlson out. What does that mean for Fox? Our own Ali Canal has the details next. Media shakeup. Fox shares sliding after the network ousted longtime host Tucker Carlson, raising fears among investors that Fox's large viewership might look somewhere else. The move comes amid a flurry of other big media shuffles. Here with more, we've got Yahoo Finance's Alexandra Canal. Ali, what do we know about this?
Yeah, this bombshell media shakeup. Tucker Carlson out. He aired his last show on Friday. In the meantime, in that coveted 8 p.m. slot, there will be a rotating cast of Fox News personalities until they can find a new host. But this is a big deal. The stock fell as much as 5% on the heels of the news yesterday, wiping off roughly $500 million from the value of Fox. Shares have since recovered. They are trading relatively flat today, but it comes at a really crucial moment considering this ousting comes less than a week after Fox settled that defamation lawsuit brought on by Dominion Voting Systems for nearly $800 million. It is unclear at this time whether Carlson's departure was related to that lawsuit, but the general vibe that I'm getting among industry watchers is that it probably was, just considering the sheer amount of discovery, the redacted filings, the information that had Tucker Carlson's name largely tied to it. Carlson, by the way, has not released any official statement of his own. Yahoo Finance did attempt to contact him for comment. He did not get back to us. But one thing that is clear, guys, is the sheer amount of viewership that this show brought to Fox. According to the latest Nielsen ratings, the program averaged 4.2 million viewers during the week of March 27th to finish the week as the most watched cable news program. So he is this undeniable force at Fox. It's clear the Murdochs were trying to send a message that not one person is bigger than the network. We'll have to wait to see what more details come, but there's this reckoning across the whole industry right now.
Well, okay, so here's the question. Tucker Carlson, personalities, politics aside, it all comes down to ad dollars, right? And whether advertisers are going to stick with that primetime program with another person in the seat or with a rotating cast in the seat. Now, some of these ad deals are probably signed already, right? For at least the next little while. But I think for an analyst, for an investor in the company, that's got to be the question, right? Are they going to hold on to the ad dollars that presumably were behind a Tucker Carlson?
Yeah, and there are some arguments that, look, maybe Carlson was a bit controversial and maybe that prevented some advertisers from wanting that primetime slot. But at the end of the day, money talks, viewership talks. So that is a big risk there. Fox does get the bulk of its revenue through affiliate fees. But cable programming, that has added to overall revenue gains. The media giant reported $451 million in ad revenue from its cable programming in its latest earnings report. So it's still a significant chunk of this revenue. It's still a big question mark moving forward. It remains to be seen how much of an impact this will have moving forward, but we'll just have to wait and see how those viewership numbers shake out.
All right, seems like Flex Seal and MyPillow will have some new competition on the advertising front for that time slot. All right, let's get on over. Thank you so much, Ali, for breaking that down. We've got much more with Ali later on. But for right now, we got to check in on some trending tickers. Julie,
yes, we do. By. First of all, let's take a look at the S&P. This is the two-day chart here, and you can see the leg down that we had this morning as investors are weighing what's going on with earnings. We got some economic data coming in just a few moments as well. But if we look at the trending tickers, of course, a lot of it has to do with what's going on the earnings front, right? That makes sense. General Motors is top trending ticker. The stock is down about 2.6% in today's session. You got McDonald's, you got Spotify, you got Verizon, you got 3M, all of these companies that are reporting earnings. I want to go over to the heat map for just a second and get a check on what's going on in the banking sector in particular. And let's just flip it right on over to the regional banks here as we talk about winding up the bank earnings season. So sort of the first phase of the earnings season, right? And what is going on with the banks as we hear now from there we go. First Republic Bank, which is down 27% in today's session after talking about big deposit outflows that were larger than some analysts had been anticipating. Outflows of about $70 billion from the bank here, even as it's now saying those outflows are stabilizing. The stock is down sharply. Let's also take a look at the two-day chart here, because remember, yesterday, this stock was rallying. That's got to be part of the story as well, because people were buying First Republic in advance of its earnings. And then we got that disappointment. So that's been quite interesting for the action too. Here's the year-to-date, still down about 90%. But you do see much more red than green on the screen when you're looking at the regional banks today, even as, and we talked to David Chiaverini earlier in the show from Wedbush, and he said, feels like the acute part of this crisis is over, but that doesn't mean you're seeing a lot of buying in the banks. When it comes to large cap banks, if we take a little survey there, we also got results from UBS today, by the way. Here's the year-to-date chart for that, down about 1.6% in today's session because it's, remember, buying Credit Suisse, but the outflows from Credit Suisse that we saw in deposits, they didn't all go into UBS. So that's been an interesting one to watch as well, Brad.
All right, quite the roundup there. Appreciate it, Julie. Guys, coming up on the other side of this short break, despite recession fears, the markets are showing cautious optimism from investors in 2023. We're going to discuss that next. Welcome back to Yahoo Finance Live this morning, everyone. I'm Brad Smith alongside Julie Hyman. We're continuing to take a look at markets here 30 minutes into the start of trade. The major averages right now down across the board. The Dow, you're seeing that lower by about 0.1%, S&P 500 by about 0.5% right now. And the tech-heavy Nasdaq, you're seeing that down as well in the red right now by about 0.6%. We do have some breaking economic data coming out right now. Julie?
We do. I'm going to do consumer confidence first from the Conference Board for April, coming in at 101.3. That is worse than the 104 that economists were estimating, and it's worse than 104 that we saw in March as well. This is interesting because a lot of the recent consumer data that we've seen, at least the confidence front, has been trending a little bit better. So it's interesting to see this one miss estimates. It looks like the present situations index is coming in at 151.1. Expectations falling, though, and that perhaps is the reason for the shortfall in the overall number, coming in at 68.1. So interesting numbers there. And then we also got new home sales. Those beat estimates. New home sales at an annual pace of 683,000. That is an increase of 9.6% month over month. And that is an unexpected increase, we should say, as well. 632,000 is what economists were looking for on that front. So I guess overall what this continues is the trend of mixed data when it comes to economic data, not giving us a lot of clear direction here about how people are feeling and what they're doing. Although I guess they are buying new houses.
Yeah, well, and I'm not in that number just yet, but hopefully one day soon. But one thing that was interesting within the Conference Board assessment here and of U.S. consumer confidence, the decline in April that we saw, while consumers' relatively favorable assessment of the current business environment improved somewhat in April, their expectations is noted here that it fell and remained below the level, which often signals a recession looming in the short term. That coming from the senior director of economics at the Conference Board. In a statement, they say that consumers became more pessimistic about the outlook for both business conditions and labor markets here. So you factor in the employment situation more broadly and start to think about, okay, what will the Fed look to in terms of the employment data that they've seen come through, which we already got the last reading on a monthly jobs report prior to their next FOMC meeting. So it's a larger question of how the Fed is going to assess the employment environment as well, in tandem with where consumers are seeing their own perspectives kind of lining up right now.
If we look at the markets in reaction to this data, we're not seeing a lot of movement one way or the other. Stocks are around the lows of the session, particularly if you look at the S&P, down about 0.5%, but doesn't seem to be necessarily reacting to these reports in particular. If you look at the year-to-date, stocks, though, are slowly recovering from the losses of 2022. This is despite sort of the rhetoric out there, right? Stocks have been going up, even though we keep hearing about recession fears on the horizon, of the collapse of the second and third largest banks in history. So what's going on here? Should investors, as Savita Subramanian of Bank of America said in a recent note, should they come to peace with the rally that we've seen and actually go out and do some buying? That was the subject of this morning's morning brief on Yahoo Finance. Emily Bowersock-Hill of Bowersock Capital Partners, founding partner, and Chad Oviatt, Huntington Private Bank Director of Investment Management. Both of them are here now in the studio. And Emily, I want to start with you. So we've had this rally, which feels like one of these rallies that people aren't quite comfortable with, right, in terms of the year to date. Should they get comfortable with it, or should they be suspicious of it?
Well, I think, frankly, the rally is a little bit of a surprise, and I am not particularly comfortable with it. I don't think people should be comfortable with it. That being said, sentiment out there is really, really negative, and so the contrarian view is the market may know something that we don't. I do think the run-up in tech stocks is overdone, and that U.S. large cap stocks are richly priced at the moment. So I think it's a good time to pare back equity holdings. I'm not in the camp that thinks this is a great buying opportunity, especially when you look at the valuation of the market versus where it was right at the beginning of 2022. This is not a huge value moment, in my opinion.
Is there a tactical shift then that you would suggest people consider making at this point in time with their portfolio?
It's an interesting point in time for sure, because we're seeing things that we haven't seen in 16 years. Cash yields where they're at, bond yields where they're at. So for us, kind of the three legs of the public market stool, if you will, are in play. A concern we have is that clients may end up getting overcashed or oversubscribed to fixed income and moving away from an equity position. So for us, not so much a tactical play, but something we've been telling our clients at Huntington is stay balanced, stay neutral to your long-term target. So if your target is that traditional 60-40, 70-30, whatever it happens to be, make sure you stay close to that target.
Why? What's the danger of being overcashed? I mean, you're getting that yield.
Yeah, great question. And so what we would point to are the expectations, the consensus expectations that rates are going to decline. Right? So when you look at Fed funds futures, or you think about markets actually going into a recession, the bond market's been in an inverted yield curve. that would suggest to us that yes, rates are good now, but there's the potential for them to decline. So even from a fixed income perspective, we've been looking at opportunities to move from short duration to more intermediate duration to lock in some of these yields. Not that we see things moving all that dramatically here in the near term, but we have decisions to make. There may be tactical opportunities in the second half of this year. But given what the market is telling us, we're not overweighting equities to our long-term target. We're not overweighting fixed income to our long-term targets. We're just keeping that balance to wait for opportunities. And even as Emily was talking about, you think about the concentration of returns right now in the equity markets, it hasn't been that broad-based. So we're still being selective there too. And we would tell people, we've been cautious on international markets for a long time. We're starting to kind of nibble on the periphery there. We're making some moves into international developed in particular.
And Emily, it seems like the markets have been giddy around the opportunity or a probability that they're foreseeing for a cut, but a cut and a pause, very different, obviously. But if there is one thing that is significant about them, either case, it's a pivot from the Fed's perspective, it seems like.
Yeah, I keep saying this. I do not think that the market is getting the Fed's message. And this idea that there's going to be a rate cut in 2023, I would be very skeptical of that happening. And I think what we're seeing here is some recency bias, because when you look at the last 4 significant rate hiking cycles that we've gone through in the last 30 years, those rate hiking cycles took place in a very different environment. I mean, it was a low inflation environment. And even those, the pause in those cases lasted from 6 months to 14 months. A pause is not a rate cut. And I think what the market is not taking into account is the idea that we could have a pause that extends significantly longer than 14 months. I think it's going to be difficult to get back to that low inflation environment that most people investing today, are used to. This is what they've spent their whole career in an environment like that. And so I think that is preventing them from really hearing what the Fed is saying.
We've been talking super high level. I want to get a couple picks from each of you before we run out of time. Chad, you in your top equity holdings for your stock strategies, and I realizing that things are tailored for different people, sure. But Emily was saying she's not a fan of getting into necessarily big cap tech right now. You guys are looking at the likes of Apple, Microsoft, NVIDIA in your global growth strategies. Mm-hmm. Why are you still looking at those stocks?
Well, so it's more about what the next several years hold. Today, obviously, is going to be a big day. We have an earnings announcement coming after the bell. But for us, it's more about the quality of those companies, things that they're going to be working on. AI, obviously, getting the big topic of discussion now for the likes of Microsoft. But even AI, NVIDIA will play in that because there's a lot of infrastructure required. That's a lot of processing power that has to run that. So when we think about our clients at Huntington, they're longer term investors. So it's not about today or tomorrow. It's about those companies doing well over the next 3 to 5 years.
And Emily, what about your picks?
Okay.
Anywhere specific?
Yes, in our case, we are also very long-term investors. We're not traders. And one of the themes, a very important theme, and people's eyes tend to glaze over when I say this, I think people are not anticipating the impact of climate change over the next 10 to 15 years and the fact that we are going to continue to see supply shocks in increasing frequency and severity. And so we're trying to find companies and parts of the market that will benefit from a continued inflationary or at least higher inflation environment than what we're used to. And so we're looking at basic materials companies, companies that are leading to cost savings and energy savings. And I would put, for companies generally, and I would put Ecolab into that category. I would put Corning into that category. We're not buying a stock for the next 6 to 9 months. So, yes, I think this technology play makes sense, but we really want to figure out what is the risk to people's portfolios? What are the unanticipated risks or the unappreciated risks? And I think climate change and the supply issues that we're going to see are not being fully appreciated.
And finally, just because both of you seem on the same page in terms of time horizon, right? And so I would ask each of you quickly, are clients on board with that? I feel like as humans, right, we're very short-termist, right? But in your portfolio, it's probably a good idea to not be quite so short-termist. Are clients and have they become more comfortable or less comfortable with that over time?
those are client-specific conversations, but it really comes down to the conversation. Our job as investment professionals is to help educate, talk through those things, listen to the client, and so we do a great job of doing that, and we think we can tailor the portfolios to their specific needs, timeframes, and help kind of refocus them from time to time. And this is one of those points in time where focus is key and conversation is key.
Emily, what about you?
Agreed. Completely depends on the client, but I would say my clients in general have gotten very comfortable with focusing on the long term. Because part of my job is to make sure that they understand this is not about 3 weeks from now or 3 months from now, or frankly, necessarily 3 years from now. This is the long-term discipline process that. But yeah, no, human nature. Humans can be frustrating.
No, they're great.
But our job is to help them.
Thank you both. Great to see you in person as well. Emily, I think first time we're meeting in person. Chad as well. Emily Bowersock-Hale, Bowersock Capital Partners founding partner, and Chad Oviatt, who is Huntington Private Bank Director of Investment Management. Thanks to you both.
Thank you.
Really appreciate it. And we got a trending ticker that we want to check on quickly. Shares of Verizon, they're not moving very much. They're down about 0.6%, but they are on our trending ticker list. And that's after wireless subscriber numbers took a hit in the quarter. The telecom giant reporting a decline of 263,000 in postpaid retail wireless phone customers as inflation battered the company's consumer business. Verizon did see positive signs on the flip side in its broadband demand, showing the largest result in more than a decade, and all of that equaling, again, not a heck of a lot of change in the shares today. Coming up, how big of a role with artificial intelligence have had in Alphabet and Microsoft earnings, and what role in turn have those two stocks had in the rally this year? We're going to talk about that next.
Hello there. Do you want to know what's going to happen when After the Call goes live for the Microsoft and Google / Alphabet, Alpha Google, whatever you're calling them, when they report earnings? Hang on 1 second. Hey, Shauna, you want to tell them about After the Call?
Oh, here I come.
All right, we're going to fill you in everything that's happening.
All right, well, I'm going to be watching Microsoft because a lot of this buzz has all been about open AI. We know AI has really been the excitement word over the last several months, so we'll see whether or not some of that holds and if it's going to be enough to offset the slowing that we've seen in Azure, the cloud business there for Microsoft. It could be a worrisome quarter if maybe that comes in below expectation.
I'm also going to be watching Alphabet, Google, whatever you're calling them at home. Google CEO Sundar Pichai has already been vocal about where we need to maybe pump the brakes a little bit on all of our generative AI ambitions, or at least the tech companies and tech spaces ambitions as of right now. But perhaps we'll hear a little bit more on that on the call. But this is still an advertising business at the end of the day. As much as you might be interfacing with Bard or Ernie Bot one day, or whatever ChatGPT's name is going to be for Microsoft at the end, it's still going to come down to how they can monetize all of these things. And advertising has been the way, at least for Alphabet and their subsidiaries, Google, YouTube, the list goes on. We've got a lot to break down for you after the call.
Well, in a new note, JP Morgan is crediting ChatGPT for the recent stock market rally. In a new note, the bank cites interest in artificial intelligence for more than half of the gains in the S&P 500 this year. But the bank does not view this as a positive thing. The strategists there say that the AI gains plus a rotation into safety has resulted in the narrowest stock leadership in an up market since the 1990s. Really interesting note from Dubravko Lakos-Buhas and the team over there at JP Morgan. And in particular, they're zeroing in on some specific stocks that they think have really benefited from this phenomenon, right? That it's been the likes of a Microsoft, for example, of a Google, Amazon, Meta, NVIDIA, CRM too, Salesforce too. So we've had other analysts sort of and strategists talk about this a little bit this year. This is a little bit of a different angle on that, focusing on AI.
Yeah, the numbers that they were putting on that, 53% of S&P 500 performance they're attributing to the language learning model innovation companies, and the performance for the Nasdaq, 54% of the growth there. So all of that considered, you think about what we're set to hear over the course of this earnings season and how many of them largely going to be expected at least to lean into that narrative even further and perhaps even show how they've already seen some of their monetization efforts come to fruition and what that run rate looks like more long term. That's, I think, what investors want to hear more about.
Well, and to me, this is the crux of this JP Morgan note. The current degree of crowding implies the risk of recession is far from priced in, right? There's such a dispersion of opinions right now on this front, though, in the markets, which is really interesting. You have, as we were just talking about with our the guests that were just on, is the Fed going to cut rates by the end of the year? That implies one market reaction. That would also imply that there is going to be a recession if the Fed is going to have to cut rates. Right. What does that mean for stocks? So it's just, there's definitely not a clear trajectory right now.
No, that's what we've heard time and time again from our guests who have said, well, look, if the Fed does cut rates, then that means they see something far worse about the economy that is actually prompting them to do so. Well, since we were talking tech here, let's stay on that thread. You can thank Microsoft and Alphabet for fueling the fervor around AI in the last few months. The tech giants both reporting after the bell today. AI, artificial intelligence, is sure to dominate the conversation. What should investors look to hear? Yahoo Finance's Dan Howley joins us now. Dan, what are you going to be looking to hear?
I think the big to-do is going to be about AI. Yeah. This is something that, and that note, by the way, at first I thought it was going in the wrong direction, where it was going to be like, yeah, everything is great. AI is going to power everyone forward. It's like, let's all, back up for a little bit. AI's been doing this for a while. This is a subset of AI that we're talking about, GPT. It's not, we use AI all the time in everything. You get on your phone, you get a recommendation, that's AI. But I digress. I think the big thing that people should be looking at, not necessarily talking about right now, is going to be the cloud and how the cloud continues to do. That's the profit driver, the driver for the stock for the past few years, especially when it comes to Microsoft, Google trying to build out Google cloud platform. They're still far behind Microsoft, still far behind Amazon. And I think, that's going to be the big discussion. They moved around some of the accounting when it comes to Google Cloud. So they're trying to make that more profitable in the interim, at least on paper, going forward. But I think, what we've seen and what we're expecting out of Microsoft for the coming quarter is a continued decline in growth, a continued slowing of growth in the cloud. And there's a number of reasons for that. Chief among them, companies cutting back on spending. And, cloud is an important part of what companies have to do moving forward. It's not a market that's completely saturated yet. There's still tons of growth there. But if they can hold off at this point in time, then that's really what they're doing. I think another thing that it's on the fringes that people might still care about, but is a multi-billion-dollar business for Microsoft. There's their more computing segment, and that's the PC sales. And they sell Windows licenses for the two third parties that sell computers. We're expecting a pretty big, substantial drop there, just because people aren't buying computers at this point. I think Gartner earlier this month had said that worldwide PC shipments dropped 30% in the first quarter. So that's gonna ding Microsoft pretty hard there. I think on the Google side of things, it's going to be, how is that ad market picked back up, right? Is it picking back up? That's YouTube ads. And any kind of commentary they're going to have on the GPT-ification, we'll just say, of search, right? They have Bard. Bard's still something that you need an invite to try out. I've been playing with it, not because I'm too cool, but I think it's something that, we're going to have to talk about what that means for search going forward, because Microsoft's already doing that. It's pretty good. I use Bing now exclusively over,
really?
Not Bing, Edge. Excuse me. Still using Google because they got the Edge there, but I do use the Edge browser over Chrome, and I mean it really does make a big difference.
I'm gonna call an audible here and ask you about your recent trip. You are just back from Japan, and I want to ask you that because, especially as a tech reporter, to sort of get outside of the U.S. bubble and go to a different place, is there anything you saw there from a technology standpoint? What people there are using that surprised you or you found interesting?
So if you ride the subway or you use mass transit in the U.S., I feel like everybody's ear, if they're smart enough to not listen to what's going on around them, especially in the New York subway, they have AirPods in. But there's not a lot of AirPods floating around there, and that's still a market that could be a growth opportunity for Apple. Japan is one of their larger markets. It's nothing like the U.S., North America, China, but it is still an important place for them. The other thing is, you sit on a bus, a train, you go out with friends and family. 95% of the time, you're probably going to see them rocking one of these bad boys. Tons of Androids still in use there. And I think that's something that, that's great for Google. They're still, look, Apple is the majority in the US, not the world. Right. The majority in the rest of the world is still Android and Google, and it will be based on pricing alone, right? So I think that's something that was really noticeable, was just how, Apple is this huge dominant force here, but you have to step out of your bubble, as you said, and that's really the big difference. And I think just to kind of add on to that, the idea of Apple in India. When I was away, all I was getting was updates from Tim Cook on Twitter about going to India, the store opening over there. They have a long way to go as far as getting any kind of traction there. The iPhone is
from a customer standpoint,
let
alone the manufacturing standpoint.
I mean, the iPhone is so expensive compared to what you can get from Chinese manufacturers. And they're all on Android. So you can open a store all you want, but if it's still outrageously priced compared to the competition, you're not going to do much.
Well, that's your next trip then, Dan.
Oof, I'll go to India, baby. Let's go.
Yeah.
Right,
get some SOG over there, yeah.
Dan Halley, welcome back, and thanks for that perspective. Really, it's interesting. All right, coming up, big day for Democrats. President Biden announcing his plans for re-election formally. We're going to speak with Transportation Secretary Pete Buttigieg on the future of the Democratic Party and his plans for transportation as well. President Biden officially announcing he's running for a second term. What will be the key factors to test his re-election campaign? Here with a deeper dive, Yahoo Finance's senior columnist Rick Newman, especially since, Rick, as we talked about yesterday, the poll numbers for both potential candidates are not fantastic.
Right. We know that the economy is going to be a huge issue for whether President Biden can get reelected. Obviously, inflation's been one of his big problems. We're going to talk a lot about that. My contention at this point is, here's the one thing to really measure Biden's success on: Ukraine. Is Ukraine going to end up with something that looks like a victory, which you might define as Russian forces back to where they started before the 2022 invasion? I sure hope so. I mean, we've got 18 months here. Just to remind people, the United States has put about $80 billion into Ukraine at this point. This is a big investment for U.S. taxpayers. I've argued before that that's actually a good investment for the United States. What we are getting for that money is Ukraine is basically demolishing the Russian army with no need for American boots on the ground there. That's actually great for us. But let's produce something that looks like a good result here. 18 months, there's a lot more the United States can do in terms of types of weapons it provides, other types of support it provides. And there has been some criticism of President Biden that he has been too cautious, that he has not gone far enough, that he has led this coalition that is providing Ukraine enough not to lose, but not enough to win. And I think it's fair to say we should see something decisive within the next 18 months.
Even after the State of the Union, the messaging from Biden was that the job's not done, which kind of gave that tee up for what could be a 2024 presidential run. What would be the core campaigning point, you believe, from Biden coming forward?
So his campaign theme is going to be finish the job. We heard that today in his campaign announcement. And he's talking about, he still has a social welfare policy, set of policies, largely unfulfilled because he couldn't get a lot of those things, a new expanded child tax credit, things like that. He couldn't get those even through the Congress that Democrats controlled for 2 years. Tons of green energy activity. We've got billions in investment. We've got tougher standards for coming out of the EPA for power plant emissions. We've got tougher fuel efficiency standards.
But how is he going to finish the job if he couldn't get the job done on all of those agenda items with the Democratic Congress?
He got some of them done.
Right.
I mean, so for example, he got the CHIPS Act done. That's a big subsidy for domestic manufacturing. He got all those green energy incentives in the so-called Inflation Reduction Act, the badly named Inflation Reduction Act. So he got some of it done. And his point is, we got a long way to go. We got to get all these policies enacted, for one thing. Green energy transition. We saw President Obama try to put some of these things in place. He did, and President Trump came in and put them right back to where they were. So I think Biden's argument is we got some of this stuff passed through Congress. There's more, but we also need to now implement this. And instead of 4 years of what he would call progress, that the next guy could overturn if it's a Republican, let's see 8 years and get this really cemented.
Yahoo Finance's own Rick Newman breaking down all things the announcement out of the White House and President Biden. Thanks so much, Rick.
See you guys.
Well, let's continue the conversation here. The latest developments in the 2024 presidential election campaigns, with Biden officially adding his name to the mix. We have the U.S. Secretary of Transportation, Pete Buttigieg, joining us now alongside Yahoo Finance's executive editor, Brian Sazi. Great to have you here with us today. And first and foremost, we have to ask you, should Biden win in 2024, do you plan on staying on with the administration? What is the tenor in the White House right now?
Look, I serve at the pleasure of the president, and I'm honored to have this role and really honored to be part of an administration that's getting so much done, especially when it comes to transportation and infrastructure. It's been the better part of a century since something has happened of the proportions that we're doing right now, improving airports, fixing bridges, enhancing railroad infrastructure, every part of our transportation system, getting these enormous investments that's coming in a very timely fashion when you consider all of the challenges that our transportation system has had to navigate. And I think it speaks to the broader story of our country and our economy and where it is. Just 2 years ago when this president took office, we had lost so many jobs. There was uncertainty over COVID. Just to take the transportation sector, today we're worried about being able to keep up with all the demand for flights. 2 years ago, the big question was, will airlines stay in business at all? So it's been an extraordinary record of accomplishment. I'm honored to be part of this team, but I also have my head down trying to make sure we can keep delivering on that, because we're smack in the middle of some major efforts right now here at this department and across the administration.
Mr. Secretary, as you know, the recent polling data has raised concerns among voters for both of the potential front-runner candidates right now, both President Biden and former President Trump. One of the concerns is around the age of the candidates. Let's just speak frankly here. You're a young guy. You ran for president. I wonder, when you think the sort of younger vanguard of the Democratic Party will now have its chance. Do you plan to run again, for example, at some point in the future?
Well, it's definitely not what I'm paying attention to right now, and of course, I can't speak to the campaign side while I'm in this capacity. But let me say this: the level of energy in this administration helps to explain the level of accomplishment in this administration. The fact that you have the most significant infrastructure work done since the Eisenhower administration, one of the most important expansions of healthcare protections since LBJ, the most sweeping and positive economic legislation and shift in policy to create more jobs since FDR, all while facing the biggest public health crisis since Woodrow Wilson. I mean, these are epic achievements that reflect the level of skill that the president has brought together in this administration and the level of energy that he brings to leading this team to make that progress. And by the way, we've done so much of it working with an exceptionally slim majority in the first 2 years of the presidency, and now with the divided Capitol Hill. And yet through it all, you've seen things done that people said was impossible. I think back to the infrastructure bill. People declared that thing dead half a dozen times before it got passed. So there was no way you could get something that big done on a bipartisan basis in today's Washington. And yet on that issue, on the CHIPS Act, on the PACT Act, which means so much to me as a post 9/11 veteran, and is going to mean so much to so many veterans who deserve to be taken care of by this country. We've been able to find ways to get things done on a bipartisan basis. That doesn't happen from just sitting around. That happens when you have a highly focused, disciplined, and energetic president leading a focused, disciplined, and energetic administration.
Mr. Secretary, you crunched the numbers on the publicly traded railroads, and a couple things stand out really, that they may have been underinvesting in their businesses over the past 5 years, and some names in particular, reinvesting that savings in dividends and stock buybacks. How big a concern is that to you that is impacting rail safety in this country?
Look, we have a lot of concerns about the business models that the railroads have adopted. They strip out the human factor. Employment at some of these major railroads is down 30%, 40%. They've become wildly profitable, but have not been able to dramatically improve their efficiency or their fluidity in moving goods. And it's really come on the backs of workers who are now overworked, stressed out. And this is part of what led to so much concern last year as workers were insisting on sick leave, something that we still believe these railroads need to provide. Some of them have negotiated it with some of their unions, but they should all be doing more right now. We're also concerned about railroad safety. It's why we're using the authorities and the tools that we've had, have been using them since day one. For example, instituting audits, something the last administration didn't do much of, reinitiating rulemakings on things like a minimum cruise size for railroads. But we could be doing more, and that's exactly why we're calling on Congress to follow through on this Railway Safety Act, bipartisan legislation that would do things to make freight railroads safer in this country and empower our department to do more to hold these freight railroads accountable. We've been able to get them to do some things on a voluntary basis, but they're not going to do these things just because we're asking. They're not going to do these things on their own. We need to make sure we have strong rules and good enforcement to hold these freight railroad companies accountable. And I can tell you, when you look at their numbers, they could do better by their workers. They could do a better job and still be plenty profitable.
In terms of the proposed GOP budget cuts, how detrimental would those cuts be if implemented to the railroad and the aviation industries?
Well, these GOP budget cuts would reduce our ability to hire air traffic controllers. They would reduce the number of hours of inspection time we have on our railroads. I'm astonished that these House Republicans think now is a good time to cut railroad safety, that anybody looking at the challenges that the aviation system has had would say now is a good time to cut air traffic control. We would have to shut down air traffic control towers if the House GOP Freedom Caucus budget cuts were to go into effect. A lot of times I think they talk about our budget, our spending, as if just anything that wasn't defense was optional. I would argue that air traffic control is not optional. It's a very important part of our economy. I would argue that freight railroad safety inspections are not optional. Lives depend on it. And those are just two examples of things that would be cut if this extreme House Republican budget proposal went into effect.
Just after the earnings report dropped for Delta, we actually had the opportunity to speak with Delta Airlines CEO Ed Bastian, who had this to offer on his thoughts about the improvements needed in the airline industry to keep pace with travel demand. Here's what he had to say. I want to play a clip and get your response on the other side.
I think we all agree, as does the FAA, as does the Secretary of Transportation, the need to continue to modernize the tools and the capabilities of the air traffic controllers. And we also need to increase the staffing levels of the air traffic controllers and the throughput in terms of taking new controllers and having them become experience ready and into those chairs. What it requires is funding on a multi-year basis.
And so, Secretary, if this funding does not get approved, what type of disruptions should travelers brace for when it comes to the summer season and perhaps even later on into the year?
Well, if you see a freeze in air traffic controller hiring, that would impact us for a very long time because it takes a long time to get controllers qualified in the first place. Now, the president's budget actually calls for adding air traffic controllers for exactly the reasons that the Delta CEO there is citing. We've got to make sure that staffing is not the limiting factor. Now, I want to emphasize, right now, air traffic control staffing is not the main reason for cancellations and delays, but it is a factor. And in order to keep that factor from growing and move it in the right direction, we've got to have the tools to invest in the people and invest in the technology to modernize FAA systems. Many of these are legacy systems. They've obviously done an incredible job in terms of the extraordinary safety record here in the most complex and safest airspace in the world. But it's not something that's just going to keep going on its own. You have to fund it. And that idea of being able to have a multi-year vision for how we're going to improve these systems, being able to have a multi-year vision for how to get these air traffic controllers in seat and be hiring at a faster rate than people are retiring. These are critically important. They're in the president's budget. And we're urging Congress to work with us to get it done. The last thing anybody should want to see right now is more cancellations and delays because politics somehow got in the way of doing the right thing for safety and for convenience of airline passengers.
Well, it certainly wouldn't be the first time politics got in the way of something, that was trying to get done in Washington. And as you said, you're head down, you're really focusing on these issues. But what's your sense of what is going to happen on the budget fight? And obviously the thing that markets are paying a lot of attention to, which is as it relates to the debt ceiling fight. What's your sense of where negotiations are at this point?
Well, first, House Republicans need to take the default off the table. This idea of taking the economy hostage in case they don't get their way is such a threat to the U.S. economy. Nobody would be better off if they follow through on their threat to wreck the economy over not getting their way by not passing a clean debt limit bill, and that has been done time and time again under Republican and Democratic presidents and Congresses. Then, once they take default off the table, we can have an adult conversation. We're in the middle of the conversation now, actually, about the budget. It's what I was testifying about in the Appropriations Committee on the House last week, and it's what we need to really focus on. Now, our budget is one that has the right kind of funding for the future of transportation. Really hard to tell, other than this kind of slash and cut rhetoric, hard to tell what their counterproposal amounts to in detail. But that's the conversation we could be having if we got over the brinksmanship and if House Republicans would make clear that they, in fact, are not willing to throw the U.S. economy over a cliff by refusing to pass a clean debt limit bill.
Mr. Secretary, thanks for your time today. Pete Buttigieg is, of course, Transportation Secretary of the United States. Appreciate your time this morning, and our Brian Sozzi as well.
Thank you.
Coming up, earnings season rolls on. We're going to break down some top movers next. Let's take a check on the major averages right now. We still see things in the red, kind of holding steady, a little bit lower than we saw at last check. Let's get to Yahoo Finance's Ines Ferre for a look at what is moving the markets. I feel like we've only gotten through a fraction of the earnings in our discussion so far, and we've talked about a lot of them, Ines.
Most definitely. But let's talk about these. Dow Inc. This is one of the Dow components, and it is the biggest laggard right now on the Dow, down more than 3.5%. This is after the chemicals giant reported its net sales of $11.85 billion. Those beat expectations, but those were down 22% year over year. Operating earnings per share came in at 58 cents. The estimate was for 37 cents, but still that was compared to $2.34 earnings per share last year. CEO Jim Fitterling in the earnings call saying that the declines in all operating segments were driven by continued soft global macroeconomic activity. He also highlighted the company's actions to deliver $1 billion in cost savings in 2023. Those cost reductions include layoffs of 2,000. Those were announced earlier this year. Moving on to the energy sector, Halliburton reported its quarterly results. The stock is down more than 3.5%. This is despite strong demand for oil drilling, for fracking services. Halliburton's profit reached the highest level since 2012, and producers have been expanding their output globally, so that has benefited Halliburton. Still, the stock and overall energy stocks today are lower. Moving on to some trending tickers that we have been watching. Raytheon Technologies down 1.4%. This is after the company reported its quarterly results, beating on the top and the bottom line. But this is what analysts have been focused on: weak cash flow. TD Cowen's analyst saying that investors should like the Q1 sales and EPS speed and strong demand visibility, but free cash flow was very weak. And then moving on to Kimberly-Clark. This stock is one of the ones that is higher today. Kimberly-Clark reporting its quarterly results up more than 2.5%. The maker of Huggies diapers, the maker of Kleenex, they posted revenue and profit which beat Wall Street estimates, but demand that slipped just slightly. It slipped not as much as expected. And organic sales, those were up 5%. The street was expecting less than that, so that was a beat. The commentary from the earnings call, basically that higher income consumers in developed countries like the U.S., they are still resilient, in part because of the essential nature of these products. So these companies, these consumer-facing companies, have been able to increase the price for their products and still beating on the top and bottom line, guys.
Yeah, the pollen out here in these streets is resilient, Inez. That's why I've been needing to buy those Kleenex. Kimberly-Clark, a beneficiary there. Yahoo Finance's own Inez Ferre, thanks so much. Appreciate it.
Thanks.
Coming up, everyone, top takeaways from Mickey D's, the Golden Arches, McDonald's, and their earnings. How the fast food giant was able to keep high traffic in the U.S. despite price hikes. We're going to discuss that next. McDonald's reported first quarter results before the opening bell. The fast food chain operator topped Wall Street's expectations despite concerns around rising costs. Let's get to Yahoo Finance's Brooke DePalma for the investor takeaways from the earnings call. Brooke.
That's right. Good morning. Well, the number to remember here is 12.6. Across the board, we saw same-store sales rise 12.6. And my vibe check overall, pretty good quarter for McDonald's here. They did, in fact, grow market share in chicken. They reiterated that people are buying Big Macs, and they even alluded to that recent revamp that they did of their burger lineup, adding and boosting sales most recently for that burger lineup. Now, intraday trading here, stock down nearly 1%. So Wall Street's reaction sort of mixed here, going down as we make way into the trading day. But executives reiterating that the company expects a recession later on this year in both Europe and challenging environment in Europe, and a mild recession here in the U.S., so possibly alluding to that lower share price here in intraday trading. Now, my three top takeaways here is consistency. As I reiterated at the top, 12.6 was that number that we saw in terms of same-store sales growth here in the U.S. In addition to that, both international markets saw same-store sales go up 12.6. And the company alluding that a lot of this was execution about how they thoughtfully passed along those increased menu prices. They continued to reiterate that their marketing efforts, core menu items, as well as the way in which they drove or planning to drive growth in terms of drive-through and delivery, continue to show results in terms of customers going to McDonald's for value offerings. They also emphasize that digital efforts there and the way that they're able to interact more directly puts them in a better position this time around as opposed to previous macroeconomic environments that were challenging. And in addition to that, we also saw accelerating the organization. We got more insight on the call as to how much they incurred because of that recent layoffs in early April. That was a $180 million charge. CFO alluded to the fact that that was related to terminating leases and employee severance packages. And so lots of insight received on the McDonald's call, and certainly consumers still going to the big golden arches in times of this macroeconomic environment.
Did they give more color about consumer behavior, not just whether they're going, but what traffic trends look like, what they're spending it on, et cetera?
Yes, the CEO, Chris Kempczinski, did in fact emphasize that in the call, that they are seeing some consumer trends. Here's what he had to say.
We are seeing a slight decrease in units per transaction. So things like, did someone add fries to their order? How many items are they buying per order? We're seeing that go down in most of our markets around the world slightly, but it's still going down. And then the other thing is we continue to monitor very closely the acceptance of our pricing. I'm really proud of how our system has executed pricing in light of the double-digit inflation that we have been experiencing. But we are seeing in some places resistance to pricing, more resistance than we saw at the outset.
But one thing that executives did emphasize, in fact, is that in good times or bad times, McDonald's does do well, and they expect to push through this challenging environment and for consumers to continue to go to the golden arches.
Thanks so much, Brooke. Appreciate it. We're going to keep talking about McDonald's right now after that strong sales report that we were just talking about, the increase in traffic as well, despite higher costs. So the question here is, McDonald's, do they have sustained pricing power even amid this weakening macroeconomic environment? Here to discuss the results as well as what it says about the consumer and the broader restaurant landscape, TD Cowen Managing Director Andrew Charles. Andrew, thanks for being here. So what can you tell us in terms of your read-through for pricing and what, sorry for the pun, what consumers are willing to swallow?
Thanks, Julie. Great to be here today. So on the pricing side, McDonald's called out that about 2/3 of that 12.6 same-store sales growth was driven by ticket, largely due to price. I would argue that McDonald's, along with Taco Bell and Wingstop, are in a very elite group for 2023 as the few restaurant concepts that we argue have pricing power, just given anticipated traffic growth for this year. And I'd say that McDonald's, notwithstanding the strategy they're doing around accelerating the arches, the success they're having with digital, with operational simplicity, with very targeted and specific menu innovation, is that what we're really excited about is that our proprietary survey data suggests that they have superior value perceptions relative to their quick service peers, that in the backdrop that we're seeing, that consumers are looking for lower price value offerings and moving away from casual dining as well as fast casual and going into quick service. We think that's likely to persist this year as our base case, and McDonald's is very well positioned to benefit given those superior value perceptions, given their $2 billion national ad fund that dwarfs the rest of the industry and positions them very well through their scale to really continue to gain share and allowing for further pricing power when needed. But I don't think they're going to be front-footed with pricing this year.
What part of the day is most important for quick service restaurants to get right at this point in time, especially considering the macroeconomic backdrop that we've been discussing and consumers who are, for different times of the day, going to evaluate whether somebody's got a good breakfast sandwich versus whether they've got a good chicken sandwich at the end of the day, or perhaps just whether or not the slushy machine, or in McDonald's case, the Frosty machine, is actually going to work.
Yeah, so lunch is their biggest day part. Breakfast, though, I would say that's probably the most economically sensitive. You see this across the limited service industry, that breakfast trends tend to correlate the most with employment growth, and kind of quantifies the common sense here that the consumer, if they are going and commuting to the workplace, they're likely to pick up coffee or breakfast along the way. And so breakfast is one I'd say let's keep an eye on that one, but lunch is definitely the core day part for quick service.
Are we going to start to see, not just for McDonald's, but for some of the other restaurant companies, are we going to start to see margins expand more as we maybe see some of the input costs moderating?
We'd love to think so. 2022 is a progressively more challenging margin environment for the industry that started the year with intense labor inflation, and around the springtime saw intense commodity inflation persist as the year went on. And so in 2023, they are anticipating that we're going to see disinflation, and I think that's a fair assumption for the industry for 2023. They did note that 1Q saw a bit higher inflation than they were internally forecasting. And so as restaurant investors are kind of at this point somewhat scarred to think that we are going to see for the industry improving margin progression. It's likely to be the case that we see commodity disinflation, but everyone's a bit nervous just given the very challenging 2022 experience.
A few years back, McDonald's had earmarked about $1 billion at that point in time to really beef up their digital play. And one of those deals was Dynamic Yield. They later ended up divesting from that. And at the end of the day, there's more now of a consumer appetite for really dealing with some of the quick service restaurants via the touch of a phone or an app. And so have those investments paid off for McDonald's? What more do you need to see from what they've put into that effort?
Yeah, we've been very pleasantly surprised that McDonald's found so much success. And what I mean by that is that because they have the drive-through where 2/3 of their sales are transacted, the fact that the consumer is still using digital and going out of their way to use digital for very entrenched behavior has been very positive, in our view. So McDonald's, they're in very early innings with this, really the tip of the spear with digital efforts. And what's been very encouraging is that across the globe, they called out that they went to about 40% of their sales in their largest 6 markets are now conducted digitally. That's up from north of 35% in 4Q of last year. But very impressive to see this as a lot of growth and a lot of the digital entrenchment, in other categories of the industry like fast casual and casual dining have somewhat stalled. You're seeing McDonald's continue to grow this. And what's even more encouraging is that they are seeing this more through their own channels, through their app and more success with their loyalty program. And that's really critical because that is higher margin.
Right.
Either these are higher ticket transactions combined with the fact that they are collecting far more data as well. And so very early innings, with this, but seeing tremendous success. And just as you mentioned, Brad, just the resources of the company positions them uniquely to really succeed with this effort.
All right, we'll keep watching those Mickey D shares. Andrew Charles, thank you so much. TD Cowen Managing Director Rochelle Akufos got you for the next hour of trading. Stick around.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching this morning. You can thank Microsoft for fueling AI further. Its mega investment in ChatGPT's owner setting off a chain reaction for investors. The tech titans start reporting today, and we are across it all. And demand for high-end models and cost-cutting paying off for GM. It's all sounding bullish, but shares are skidding. So what happened on that results call? We'll give you all the details. And tuck it out. 14 years after starting as a contributor, the most famous face in cable news has had his last broadcast for Fox. So what's next? We look at the future for two big brands. But first, let's take a look at the major indices. We still see here some selling action going on here. The Dow, they're off about 0.2%. They're about 62 points. The S&P 500, they're also down about 0.2%. Taking a look at the tech-heavy Nasdaq there, also down about more than 100 points there, as we're seeing some of these earnings continue to roll in and really trying to get a guide there based on what we'll see from these big tech earnings. Let's also check in on the Treasury market. We're seeing something of a flight to safety here. The shorter-term yield here, the 5-year down almost 4% on the day. The 10-year also down about 3.3%, and the longer-term 30-year down about 2.5% as well. All right, turning now to our top story, gauging the pressure. UPS and McDonald's out with earnings. These two companies closely watched as indicators of the health of the US consumer. McDonald's showing consumer strength and traffic despite price increases, while UPS disappointing on weakening consumer demand. Here with his economic forecast, Yahoo Finance's own Josh Schaefer. Hey Josh, what are you watching?
Hey, Rochelle. Yes, I was taking a look at some research out of Bank of America this morning about just a recession as a whole, right, and how priced in that is to the market and sort of what it looks like. And at a historical rate over the last decade, Bank of America research shows that a recession is as expected now as it's ever been. It's actually more expected now than it has been in the last decade. That's following that light blue line on your screen there. And it's as expected as it should be, I guess I should say, besides COVID-19, right, which is a little bit of an outlier. But also following that, Bank of America is saying how S&P 500 companies are at a healthier point right now if we are already in a recession or headed into a recession than normally expected. So we've been taking a look with over a quarter of the S&P 500 reporting this week. We've been taking a closer look at sort of what we're seeing. And so when you take a look at UPS this morning, UPS, obviously, you pointed out, Rochelle, that stock down almost 10%, has been dropping all morning. And UPS's numbers came in worse than expected, about in line. And really the headline, though, was that they see 2023 being bad overall. So they see management saying that volume was, quote, higher than expected in January, closer to our plan in February, but then moved significantly lower in March. They see that trend continuing. That trend follows what you've seen broadly from retail sales, of course, too. So UPS sort of saying what you've seen in retail sales and the overall economy has played out for us. They're now guiding for overall revenue for 2023 to fall about 3%. That's UPS. I should point out the other thing with UPS, of course, Rochelle, is we'll get a closer look too at e-commerce sales from Amazon, because UPS numbers falling, while that is something to pull from, you do also wonder what Amazon says on Thursday about sales. And then I think we want to also hit on McDonald's here. And McDonald's saw growth. McDonald's beat on revenue, beat on EPS. And really the key stat, though, to me from McDonald's was that same-store sales number, right? So analysts had expected 7.5%. That number was actually up 12.6%. And the fun part with McDonald's, Rochelle, is we could say, well, McDonald's is recession-proof. People are still buying Big Macs and people are still buying French fries. Sure, but the real question is that new customers? Is McDonald's same-store sales up because people are actually trading down and they're going to McDonald's? I'll point to another earnings release we're waiting for, Chipotle, today after the bell. That will perhaps give us another look when they also release their same-store sales. Are people trading down from a fast casual like Chipotle that's more expensive to something like McDonald's? A lot of different indicators to take in here, of course, but it's fun to track and follow, and we're excited to do it, right?
I love that. And a lot of nuance there when we're looking at what's happening with some of these fast food restaurants. Great stuff there. Our very own Josh Schaefer. Well, earnings, of course, only one part of the picture when it comes to what the consumer is telling us about a potential recession. The Fed narrowing its focus to key employment indicators ahead of its decisions. Joining us now is Blarina Urucci, Chief U.S. Economist at T. Rowe Price. Good to have you on the show, Blarina. So obviously we've got some of these bellwether earnings that really give us some idea about the consumer, but What what else is telling us about the consumer here? When you look at indicators, I know you're also focused on what we're seeing in the labor market.
Thanks for having me, first of all. It's great to be here. And as I listen to your discussion about various earning reports on the consumer side this week for the U.S. economy, what comes to mind is this ongoing shift and rebalancing of U.S. consumer spending from goods to services. And so there's going to be winners and losers in the stock market as this process unfolds. But I do think that the underlying conditions for the U.S. consumer are pretty solid. And that's based on the health of their balance sheet and credit scores and delinquencies, which are all pretty low post-pandemic. And it's also based on my view that the U.S. labor market remains resilient. We're seeing some easing in labor market tightness. We had peak tightness in 2022. Now we're seeing lower vacancy rates and lower hiring intentions, but we're not seeing broadly based outright job declines and job cuts across the economy. What we're seeing is the economy continues to add jobs. And so I think that's key as the Fed meets next week and sort of decides how far to increase interest rates. One key indicator for me will also be the earnings data that the wage inflation data that we get on Friday of this week. This will be the ECI index for Q1. And here I think it will be key because the Fed focuses a lot on this measure. It is less volatile than other measures of wage inflation. It hasn't had some of the distributional issues that average hourly earnings has had. And also it's important because I like to focus on three broad wage inflation measures. Two of those measures right now are moving in opposing directions. The average hourly earnings measure is trending lower. The Atlanta Fed wage tracker is trending higher. So it feels like the employment cost index that we get on Friday is going to adjudicate which of these trends we should be paying attention to.
So then as we're trying to make sense of some of these indicators going in opposite directions, and we know Jamie Dimon talked about, the strong balance sheet as well for the consumer, what is it telling us then about the US ability to perhaps avoid a recession then?
So I think this is important to keep in mind that there is strength in the U.S. Consumer balance sheet and there is strength in the U.S. labor market. I think this makes the economy less interest rate sensitive than it has been in the past. So whereas in past business cycles, with this pace of interest rate increases and this level of interest rates of about 5% or so, we might have expected the economy to stumble into a recession. And consensus expectations were, in fact, for a recession to have happened late last year or early this year. In fact, those fears did not realize. I think as we look forward, there's going to be an ongoing adjustment in the economy. I do think you need to cause more labor market pain and more labor market easing before we can bring inflation down. And we all know that the Fed remains very focused on bringing inflation down from current levels. And so when I look at the US economy and what to expect for the tail end of this year or early next year, I do think those recession probabilities are elevated.
Now, I want to talk about layoffs. Obviously, tech layoffs have really dominated this space. We at least hadn't seen it move beyond some of these white-collar industries, but we're still starting to see some of that pick up. And when you add to that then Fed tightening, and then after the fallout from SVB, some of this credit crunch talk as well, and as well as manufacturing slowing down, then how should we be preparing ourselves in terms of the layoff picture?
Layoffs are very interesting. In Q4 of last year, the data was telling us it was all focused on tech. And then in January and February of this year, it started becoming more broadly based. It cut to industries like medical services, but still, I don't think it's broadly based enough in the economy to lead to a negative payroll number, which I think would be the ultimate warning sign that the economy and the labor market are really rolling over. What I'm seeing right now is a broadening in job cuts, but still with a significant focus in white-collar workers. And then also what I'm seeing in the distributional data for the concentration of savings, I'm seeing more savings and excess savings still in the high-income earners and the high end of the distribution, where we're seeing the layoffs, and I'm seeing lower savings in the lower end of the income distribution, where the job market is still pretty strong and pretty tight. So I think this combination is likely to lead to continued strength in consumer spending. Now, it's not going to be as strong as it was last year. We are in a decelerating phase, and that makes a lot of sense given the tightening in financial conditions, but I don't think it's doom and gloom either.
And I want to also just quickly touch on the housing market. Obviously, you had the shock to the system last year as interest rates then continue to rise this year as well, and mortgage rates. Is more pain still ahead, or do you think we've actually reached a bottom at the moment?
It feels to me, when I'm looking at sales and starts data, that we're reaching a bottom in terms of construction and residential investment in the U.S. housing sector. Now, let's rewind a little bit and remind ourselves that residential investment has been declining for 7 consecutive quarters. And that made a lot of sense in response to a significant amount of building immediately post-COVID, and also the increase in mortgage rates. But now rates seem to have stabilized, and there's been already a lot of pain that has been felt in the housing market. So I feel like we're stabilizing, we're reaching a bottom, and I don't expect residential investment and housing sales to be as much of a headwind to growth this year as they were last year. In fact, I expect their contribution to be more neutral.
Certainly a lot of indicators to watch there. We do appreciate you giving us your insights. Florina Yarucci, Chief U.S. Economist at T. Rowe Price. Thank you for your time this morning. All right, coming up, GM boosts its guidance after beating the street with first quarter results, but there was a twist for investors on the earnings call. Find out what happened next. Demand for high-end models and cost-cutting paying off for GM. It was all sounding quite bullish, but what was the scuttlebutt on the earnings call? Yahoo Finance's Pras Subramanian was plugged in. Pras, what happened here?
Hey, Rochelle, another strong quarter for GM, big earnings, revenue beat here. Not sure why the stock's kind of a little bit weak here, but the company said it actually gained market share and is now the number 2 market leader in EV sales in the U.S. But this led GM to boost its full-year profit guidance following that strong Q1 result. Now seeing adjusted EBIT of $11 to $13 billion, up from its prior outlook of $10.5 to $12.5 billion. So good news there. But a little surprise here on the call. Maybe this is what's going on. GM CEO Mary Barra indicating the end of the line for GM's popular Bolt EV. Take a listen.
We have progressed so far that it's now time to plan to end the Chevrolet Bolt EV and EUV production, which will happen at the very end of the year. When Orion EV assembly reopens in 2024 and reaches full production, employment will nearly triple and will have a company-wide capacity to build 600,000 electric trucks annually.
It seems GM is bullish on the arrival of its newest EVs, and that the coming Equinox EV, the Bolt isn't needed. On a slight down note, GM's business in China slipped a little bit in Q1. Here's what GM's team had to say about that.
China is in a period right now because of where the industry is and the number of competitors with the pricing challenges that will sort, and I think we'll be well positioned. We do have brands that have value in the country, and we're going to have the right EV portfolio there.
So that being said, my key takeaways here. Let's first off start with operation strength. Better than accepted take-up rate of its voluntary buyout plan. Also cost controls with production seemingly back to normal. Secondly, the EV rollout seems on schedule. New battery plant announcement today with Samsung SDI means a fourth plant is on the way. And last but not least, GM's traditional business is still strong. Truck sales are chugging along. Customers ordering top trim levels for the Silverado and Sierra pickup. So in terms of a vibe check, I'm going with a 4, or I'm going with strong here. Strong, that's a 5, I guess. Good, right? Things looking good in 2023, raising profit guidance, EV rollout on track. The only real issues here are, will GM be able to replace those Bolt EV sales at the end of the year? Back to you, Rochelle.
How's that? Bye-bye Bolt. Well, on to bigger and better, I guess. Great stuff there. Thank you, Praz. All right, shifting gears now to big tech. Now, you can thank Microsoft for fueling the fervor around artificial intelligence in the last few months. Its mega investment in ChatGPT's owner setting off a chain reaction and some rocketing valuations. The tech titan reports fiscal third quarter after the bell today, and Yahoo Finance's Dan Howley will be across those numbers. Dan, what are you watching?
Yeah, I think, obviously the big discussion is going to be about ChatGPT. You can expect them to discuss AI about 10,000 times during the call, and I'm sure that's the same amount of numbers that analysts will be asking about AI. One of the things that is getting lost here, though, in all the AI hype is cloud, and I think that's been one of the big drivers for the stock price for years. It's also where they get great margins. So far, we don't know what kind of benefit we're seeing from the ChatGPT OpenAI billions of dollars that they've invested, or when we'll see that. They've implemented it across their products, whether that's Microsoft 365, their security offerings, Teams, Edge, and the Bing chat bot that they have. But we don't know yet what we're seeing as far as a revenue stream benefit. Maybe we'll get something there, although they just announced these products in the past few months, so doubtful. But yeah, the cloud is what we're looking at as really something that'll give us, a firm idea of how Microsoft is doing. And so far, the projections for the cloud are for, growth to slow again. That's something we've seen since at least Q3 of 2022. It's something that we're going to likely continue to see going forward just because of the economic environment. And, according to best estimates, I think I was looking at 13% growth year over year. That's down. At one point, there was 30% growth. If you look at the server and cloud products, they are expecting growth or they saw growth at one point at 20%. And so, we're still trying to figure out where exactly the cloud is going and when it might pick up again. This is all, of course, related to the fact that interest rates are high, so companies are pulling back on their spending. Cloud and security, those are really important for these businesses. To see them pull back on that, they've done thousands of layoffs, right? So they're cutting corners where they can at this point. I imagine at some point they'll have to start seeing reinvestment. So the cloud, I think, though, is really going to be the big story here. AI is great. It's fun. It's interesting. It's what everybody wants to talk about. But cloud is going to be the most important.
And you raise an interesting point. AI creating a lot of the buzz. But when it comes to the meat and potatoes of Microsoft, you're thinking of the cloud business. I wonder, do you think we'll hear much about the gaming aspects of the company as well?
We could, right? I mean, they still have the Activision Blizzard acquisition that's out there. They've gotten some good movement around the UK as far as potentially moving forward with that acquisition, though here in the US, it's still going to be under the FTC investigation and whether or not they'll move forward with that, whether or not Microsoft can push back successfully. So that's something that is clearly important. And, you know, it's worth pointing out for that Activision Blizzard acquisition, yes, they want Call of Duty, which Activision Blizzard makes. That'll get them huge numbers for their cloud offering with Xbox Cloud Gaming. The mobile side of things, though, is really, I think, what's kind of left out of the equation, the important part here, because mobile, fastest growing, most lucrative part of gaming. It doesn't take billions or hundreds of millions of dollars to make games on mobile, and people just, you know, lap it up. So I think the other thing that we'll have to look at, and this is going to be potentially another negative, is Microsoft's more personal computing segment, which is part of where Xbox and the gaming is reported. The big deal here is a decline in PC sales. According to Gartner, they saw in the first quarter of 2023 a 30% year-over-year decline in PC shipments. And that's likely going to hurt Microsoft. They're expected to see some of the sales drop, potentially revenue drop 15.5% year over year to $12.3 billion. That's down from $14.5 billion in Q3 2022. And the reason for this really is just because people don't need PCs at this point. They're trying to save money where they can. Things are more expensive. And if you bought a PC during the pandemic, you don't need one now. Businesses are doing the exact same thing. And so that's why we're seeing people pull back there. And it's likely going to be like that potentially for some time. You know, I spoke to an analyst during the last quarter, and they said don't expect, you know, things to start picking up again for a couple of years for the PC market.
I mean, you figure at some point we'll get back to some sort of normal. As you mentioned, everyone sort of clamored for these gadgets during the pandemic. Different time now. A big thank you to Yahoo Finance's Dan Howley. And of course, don't miss this evening's After the Call from 6:30 p.m. Eastern Time. We'll be giving you the scoop from both Microsoft and Alphabet's earning calls. You don't want to miss those. All right, coming up, once upon a time, it was one of the world's biggest conglomerates. The times are changing at GE. Has the big split doubled your investment opportunity? We'll find out next. General Electric beat Wall Street's estimates for profit, sales, and cash flow in a strong first quarter. Now, these earnings give a temperature check ahead of General Electric's planned split. GE will break two separate companies, one focused on aviation, the other on energy in 2024. The company's aerospace division, which will eventually become GE Aerospace, had a strong first quarter. The franchise logged notable gains in revenue and profit. Guidance was also boosted thanks to a positive outlook for aerospace demand in the years to come. Now, the remaining portfolio of GE's energy businesses will be held under GE Vernova. It includes a large investment in clean energy. In the first quarter, GE's renewable energy sector saw significant growth in orders, but is still operating with negative margins. GE's healthcare division already split off earlier this year under the ticker GEHC. The company reported as an independent operation this quarter, beating estimates. Well, joining me now to discuss what GE's latest earnings mean ahead of its eventual split is John Eade, Argus Research President. Good to have you on the show, John. So first, obviously, we're looking ahead to, of course. So I want to first get your takeaways because in 2024, we're going to get this split between the power business and the aerospace business. How are you valuing each part of this business?
Well, they are two very different businesses, as you just illustrated. And the trends are different for them, too. The aerospace business is hot right now, and that's because Boeing is back to producing the 737 MAXs. That's because commercial air travel is returning to pre-pandemic levels. So these are great times right now for aerospace, and the business is reflecting that. The power business, though, is more of a turnaround. So I think I'm looking at aerospace as a growth business, although I don't expect it to grow this fast into 25, 26. And I'm looking at the power business, the Vernova, as a real value business and a turnaround opportunity.
And I do recall when you were on Yahoo Finance in 2021, you said that CEO Larry Culp inherited a train wreck. What are your thoughts then on his turnaround for this business?
Well, it's coming together, and I had thought it would come together faster than it has, but the pandemic got into the way, deglobalization and supply chain issues and inflation got into the way. But I do think the results that the company reported this morning are indicative that the turnaround is occurring. Like you said, there was revenue growth. There was margin improvement. The company turned cash flow positive, and that was very much a hallmark of Culp's days back at Danaher. And now the company is even buying back stock. It hasn't done that for a while. So it's still, I think, early, where the turnaround isn't complete, but the progress is definitely there.
And so expectations for the upcoming split, I mean, obviously they're very different kinds of businesses, but even as we look at GE's healthcare business that it spun off in early 2023, that's gained about 31% year to date. What are your ideas on where you see the health business going versus some of the other aspects of GE?
So, the healthcare one was in great shape coming right out of the pandemic. Remember, the aerospace took a little bit longer to come around. But healthcare was shiny. They spun it off. They sent it out at a discount to other healthcare companies. The price to sales ratio was lower. The price to earnings ratio was lower. So as people have gotten to understand that business, I think as a standalone business, it has performed well in the market as it's moved up to more normal healthcare valuation levels.
And a part of the business that hasn't posted it as well in terms of operating losses, it's renewable energy side of the business. What do you think are the biggest issues that GE is having in growing that business? And at what point do you think it will become profitable?
I think that's probably their newest business. Not like it's brand new, but it's still relatively young. And if you look at the revenue composition, they're selling a lot of equipment when they do sell. Right? Orders were up 94% this quarter. So it's very volatile on the orders. But remember, the real profit comes in not on the equipment sales, but on the service contracts that they sign once the equipment gets into place. So they're still selling a lot more equipment. And as that equipment is established, and then GE starts to service that business, I think that's when you're going to see the more consistent profitability. And I'd put that out 2 or 3 years from here.
And so then what do you see as the biggest risks for that side of the business as it's emerging?
Well, you and I have just been talking about the income statement here. We haven't seen what GE is going to do yet with the balance sheet. My thinking is that they'll probably have aerospace come out pretty lean on debt levels, and they may saddle the Vernova business with higher levels of debt. And if interest rates are still on the high side, that's going to cut into margins and cash flow. So I'm going to, I guess, reserve final judgment until I see those details of the balance sheet announced.
Certainly be keeping an eye on that. We'll be tracking that as well. A big thank you to John Eade, Argus Research President. Thank you for your time today. All right, coming up, Fox News makes a lot of revenue for its parent company. Is that all about to change after it parted ways with Tucker Carlson? We look at the changing media landscape next.
Hello there. Do you want to know what's going to happen when After the Call goes live for the Microsoft and Google / Alphabet, Alpha Google, whatever you're calling them, when they report earnings? Hang on 1 second. Hey, Shauna, you want to tell them about After the Call?
Oh, here I come.
All right, I'm going to fill you in everything that's happening.
All right, well, I'm going to be watching Microsoft because a lot of this buzz has all been about open AI. We know AI has really been the excitement word over the last several months. So we'll see whether or not some of that holds and if it's going to be enough to offset the slowing that we've seen in Azure, the cloud business there for Microsoft. It could be a worrisome quarter if maybe that comes in below expectation.
I'm also going to be watching Alphabet, Google, whatever you're calling them at home. Google CEO Sundar Pichai has already been vocal about where we need to maybe pump the brakes a little bit on all of our generative AI ambitions, or at least the tech companies and tech spaces ambitions as of right now. But perhaps we'll hear a little bit more on that on the call. But this is still an advertising business at the end of the day. As much as you might be interfacing with Bard or Ernie Bot one day, or whatever ChatGPT's name is going to be from Microsoft at the end, it's still going to come down to how they can monetize all of these things. And advertising has been the way, at least for Alphabet and their subsidiaries, Google, YouTube, the list goes on. We've got a lot to break down for you after the call.
A bit of media madness recently taking hold within networks as they let go of long-standing on-screen talent. One of the most notable shakeups being Tucker Carlson's departure from Fox News, bringing an end to Carlson's run as the host of one of the network's highest-rated primetime shows. Here to discuss is Axios Pro Media Deals reporter Kerry Flynn. Kerry didn't have this on the bingo card for sure going into this. So talk about this announcement. Obviously, we saw this stock take a bit of a hit here, but social media, a mix of glee and outcry as well, but essentially shock across the board here and a very curt announcement from Fox. Where does Fox go from here?
Thanks for having me. And yeah, you're right in saying it was a shock. It was a shock for fans and his not so fans. It was just surprising in the fact that we had the news just last week that Fox News settled with Dominion Voting Systems. And so, that was huge. It was a big hit in the fact it was the largest settlement that has ever happened in a defamation suit. So yeah, that was shocking in itself. To then have the news come out that not only their biggest star, but one of the biggest stars in US cable news history being ousted, the immediate questions were, was this part of that settlement? From our reporting and others, it seems to be that wasn't the case. But perhaps some of the news that came out of that settlement, that Tucker Carlson was being disparaging to his colleagues in private settings, really propelled that ousting from the network.
And then also, of course, the claims of harassment and sexism from former producer Abby Grossman. So when you sort of put all that together, then a lot of conspiracy theories still flying on social media as to why he left. But what does that mean for where Tucker Carlson goes next when you have such a name associated with such a brand?
Correct. I would say Tucker Carlson is Fox News. Where he goes next, the issue is that, yes, while he's a big name, Fox News was his platform, right? But truth be told is that he's worked at many networks before, so it's not his first time moving from another network and taking his fans with him. They did elevate him to future stardom. So we haven't heard from Tucker yet publicly what he'll do. Will he start a Substack? I don't think so, because he's definitely a video person. Will he join one of those right-leaning conservative networks like Rumble that are more direct-to-consumer than a TV network? Maybe. I think he has some time to figure it out, given that what's been reported is that Fox News is paying the rest of his salary. So he's not having to run for money at this moment.
Yeah, it's certainly not small change he's making over there. And now a lot of people wondering, though, who could be out next at Fox? I mean, you still have the Smartmatic $2.7 billion defamation lawsuit, also tied to the 2020 elections as well. Do we know then perhaps who else might be out at Fox next?
That's definitely the biggest question right now is, will there be other shoes to drop? Will there be other quote unquote sacrificial lambs? It doesn't seem like that's the case right now, but really the big question, you mentioned Abby Grossman's lawsuit, that was really focused on Tucker Carlson's behavior from what we understand. But there is also the lawsuit from Smartmatic, which was actually a bigger number than that Dominion lawsuit, and that has not, is still ongoing. So whether or not there'll be more texts that come out of there that look bad on one of their other stars, we'll see. We don't know yet. And I don't want to make any guesses because, again, Tucker Carlson admittedly was a huge surprise to me and I think the rest of the industry as well.
Indeed. And then, of course, same day, you have CNN parting ways with Don Lemon. A little bit of back and forth as to the nature of how he was notified and you know, sort of how this really unfolded, some back and forth on Twitter. But in terms of his role at CNN, a little bit less of a shock from what I can understand on social media.
Definitely less of a shock. Don Lemon had been on thin ice for a while at CNN. Definitely when the new regime took over, when Chris Lecht became new CEO, there was the move from Don Lemon from primetime to the morning show. You could spin it to say, you know, it's a big opportunity for Don. It was a big morning show, but he went from hosting his own show to being a part of a table. And so, yes, that was kind of seen as a demotion. But he just, in that new setting, had a lot of embarrassing gaffes in the public light. And then also there was upsetting, disparaging moments behind the scenes. And that's really the antithesis you want out of a morning show, especially a brand new morning show. So again, he was on thin ice for a while, and it just seems like it was the final blow came last Friday when the White House press secretary reportedly said that she did not want to be interviewed by Don. That is a huge loss of credibility to him as a reporter, and also just really bad look for CNN overall. It really affects their ability to do their job, to be that trusted name in news.
And then, of course, with the big guests and also advertisers watching as well. Also, just want to quickly bring up Jeff Shell, because this was quite the week for media, also out at NBC. Talk about that as well, as you have these major networks really having these very public sort of falls from grace.
Correct. We thought, as a media reporter, thought that the biggest news of the week would be Jeff Shell, the CEO of NBC Universal, getting fired from his job on Sunday. Turns out those two other news stories we just talked about happened on Monday. So Jeff got a little break from the news cycle. But it's a bad look. You know, how these instances all related are the fact that they were all related to misconduct. Very different misconduct for Jeff Shell's scenario. He was fired due to an inappropriate relationship with a woman. We didn't know who that woman was and what the details were on Sunday. Those started to come out on Monday. Axios has reported that the name of the woman is Hadley Gamble, who is a reporter at CNBC, an international correspondent. And her lawyer confirmed that Hadley has filed a sex discrimination and sexual harassment lawsuit. That's extreme. It's not allowed. It's not appropriate behavior. Again, very different, but we did talk about those really bad things that Don said on air that caused people to not respect him. And then Tucker Carlson has a history of misogynistic reporting and also behavior behind the scenes. So again, that's kind of how all those relate. Unfortunately, we're in this era of Me Too. We've been a part of this Me Too movement for a while now, but here we are still having men behaving badly. But the truth is that the consequences continue to be realized.
No, it's true. And then when you factor in cost-cutting measures and other considerations, it's just an interesting time at the moment. And, some of these networks having to make some tough choices here. A big thank you there to Axios Pro Media Deals reporter Kerry Flynn. Thank you so much for joining me this morning.
Thanks for having me.
All right, coming up, Spotify boasts its largest ever first quarter growth in monthly active users, but has the strategy to lean into the podcast space paid off? We turn up the volume on the stock next. Time now for our chart of the day. Today we're looking at the streaming business, focusing on audio. Spotify and other audio streaming platforms grew subscribers rapidly during the pandemic as people were encouraged to stay at home. Now that drove the demand for content, resulting in more than a 20% increase in paid music subscriptions from 2020 to 2022. However, investors are now concerned that we're near the point where everyone who could be paying to stream music already is. Well, to that point, Spotify reported mixed results this morning, but investors still rewarding the company with shares up about 6% right now. Here to tell us what's boosting sentiment is Yahoo Finance's Alexandra Canal. So, Ali, you also listened to the earnings call. What did you learn?
Hi, Rochelle. Well, the main takeaway for me is that Spotify is delivering on its promises, at least so far, despite that miss on revenue, a wider than expected loss. The company did beat expectations on margins. It also continued to crush subscribers. If we take a look at monthly active users, that was very impressive, coming in at 515 million, beating expectations of 502 million. Premium subscribers also outpaced estimates at 210 million versus the expected 207 million. And looking ahead to the current quarter, Spotify does expect to report MUAs of 530 million, with premium subs expected to reach 217 million. So just insane numbers right there. But going back to those margins, this was a story that goes back to 2022, where investors were increasingly disappointed at Spotify's margins, especially after the company heavily invested in podcasts. Yet management had maintained that the company will be much stricter on spending in 2023 and that investors will see sequential margin
margin improvements, which we have seen so far with margins coming in at 25.2%, beating estimates of 24.9%. Another takeaway here is the ad market. That pressured revenue in the quarter, with CFO Paul Vogel telling investors the quarter was choppy again. He said they're cautiously optimistic moving forward, but quote, "We feel really good about our relative position in the ad market and how we performed." Finally, when it comes to pricing, analysts expect the company to hike subscription fees in the coming months, especially amid that profitability push, but it did not happen today. Still, X said that he was willing to raise prices when the time is right. Here's a little bit more of what he had to say on that earnings call.
So we have many tools at our disposal as we're thinking about how to increase growth, and the industry realizes that, and our label partners realizes that as well. So that's the constant dialogue that we're in. But yeah, we would like to raise prices in 2023, but it's really a discussion with our partners.
So hinting that those price increases could come at some point this year. But again, as X said, it's all going to depend on negotiations with those label partners. So for all of these reasons, I'm giving a positive vibe check when it comes to Spotify earnings, primarily driven by that margin beat. The fact that management did reiterate that they are going to continue to be very careful about their spending. They're going to be looking at all of their content investments to make sure that they're not overspending. And this is surprising to me, because if you told me this time at the end of last year that I would be giving a positive vibe check to Spotify earnings, I wouldn't have believed you, because they were a company that really struggled with that. But it does seem to be that they are on this path and on this strategy of speed and efficiency. And that's why we're seeing this bullishness both on the street and in the stock today.
We're certainly seeing that more strategic aspect paying off in that stock price there. Ali Canal, thank you for that update. All right, we're sticking with Spotify. The streaming giant has made huge moves in the podcast space over recent years, investing over $1 billion in 2021. Now, that money was spent on deals like the acquisitions of Gimlet Media, Anchor, Parcast, and The Ringer. It also gained the exclusive rights to Joe Rogan's podcast and signed TikTok influencer Addison Rae, Kim Kardashian West, DC Comics, and Michelle Obama. Well, Spotify's paid user growth in the first quarter is likely to boost margins, but some investors are still focused on the ad revenue and what's to become of the company's heavily invested podcast division. Joining us now to discuss is Magnificent Noise co-founder and podcast strategist Eric Newsom. Eric, thank you for joining me this morning. Now, we remember when they were just throwing money wildly at some of these podcasters. Of course, Joe Rogan is the main one that comes to mind. Where are we now in the podcast story?
For Spotify, or just generally in the entire industry? I think that for Spotify, they're at a pause moment of trying to look at the investments they've made. Some of them have paid off well. Some of them have not seen the kind of payback that I think they were hoping for. And that's actually reflective of the larger podcast industry, actually, that many companies have seen an easy flow of money in to make investments. They're taking very much of a startup perspective of making lots of investments to see what plays out and what doesn't. And now we're kind of dealing with the reality creep in with the softening of the ad market.
I mean, when you look at now how crowded, as we look at that top podcast platforms graphic there, when you look at how crowded now the market and the space has become here, how does Spotify really move from this point, especially as we hear Ek talking about potentially raising prices?
It's interesting when you look at this chart. There are so many different ways of looking at the podcast industry. This is top podcast platforms. I don't think this reflects the reality of where listeners are going to experience podcasts, and that's still heavily dominated by Apple. Usually between 50 and 70% of the show's downloads come from Apple, but Spotify is number 2. And as recently as 2 or 3 years ago, 4 years ago, that would have been in the low single digits, like many of the numbers you see here. So one thing that has come out of Spotify's investments is they've become one of the number 2, and in some territories around the world, the number 1 platform for listening. The problem with that is that has not clearly translated into dollars, into revenue, while it has given them a place at the table, and a very commanding place at the table. And those investments have made quite an impression on people. They haven't been able to translate that into something that is of value to the company and its shareholders.
So what is the company going to have to do then to make that translation so that it does actually end up translating into dollars?
Well, it's a very good question. I think they'd love to know the answer to that question too. That they, I think probably the smartest decision that Spotify has made since this investing over $1 billion into podcasting has been the latest decision to basically stop a lot of their content creation efforts and pull back and reassess and ask some rather existential questions about what do they need podcasting's role in the company to be, and what do they have to offer to the podcast industry that is better than what other people are offering. It's a very important platform, but if you look at it from the experience of creators and listeners, it's just a matter of preference. There's not really a clear distinguishing thing. And I think that Spotify needs to think about, what does Spotify mean? What can only Spotify do in the podcast industry to create things for listeners, to create things to entice creators to favor that platform as a distribution point for their content. And until they have a clear idea of what that means, as far as what their role is, a lot of these acquisitions will continue to kind of flounder. Some of them have, some of them haven't, but you can't expect there to be a clear path forward until they really understand what the company is trying to do, what role the company wants to have, and what role podcasts play inside of Spotify.
And to that point then, so if you're an advertiser looking at where to best position your ad dollars to get the most bang for your buck, and you're looking at the wide array of platforms that are out there, is Spotify really the place to go then?
It depends on the audience you're trying to seek. There are times when Spotify speaks to many millions of people, and it's a great platform. Ad buyers don't want to go to 1,000 different places to place advertising. They'd rather go to a large player who represents a great portfolio of products. And I think Spotify aspires to be in that place. I think in some regards they have achieved that, but it's a very small amount of the advertising in podcasting is going to Spotify. And until they can make a distinction for a creator or talent, as everybody talks about the Joe Rogan deal, for example, for Spotify, which is such an outlier. It's an example of nothing. And but if you look at the many other creators who are creating content and audiences are listening to content other than Joe Rogan, a lot of those don't really look to Spotify as being an advertising platform because they can make more money and have more control doing it on their own.
And so then when we look at where the future of podcasting is heading, obviously you have the big celebrities, that was sort of all the craze. What does the next sort of new normal for podcasting look like?
Oh, that's a great question. And I'm not sure anyone has a good answer for it. But I would say that I think a lot of companies are going to find their next chapter by focusing on audience segments. Like when we look at the broad audience, which of those segments do we want to serve with content that we are either creating or acquiring and distributing? And that the focus will be less on talent or celebrities or even categories and more on audiences. When I want to serve this audience, what type of content are they interested in and how can I create something that simply couldn't be doable by anyone else? And I think that many of the audacious deals that Spotify has struck over the past several years have been very bold. Now it's time to deliver content which has a similar sense of boldness, but for specific audiences rather than trying to think that one thing can serve many, many, many varieties of people.
Because it's true, because it can be very overwhelming when you just sort of jump in and, but some of these more nuanced audiences, I think, as you mentioned there, the way to go. A big thank you there to Eric Newsom, Magnificent Noise co-founder and podcast strategist. Thank you for joining us on Yahoo Finance today. All right, coming up, JetBlue is ticking higher after posting record revenue for the quarter. We'll break down some top trending tickers next. Now time for today's trending tickers. We're watching shares of JetBlue. The airline giant's adjusted loss per share came in smaller than expected, and it posted record revenue as it continues to see strong demand. The company is forecasting a profit for the second quarter as it expects robust summer travel. Despite operational challenges, the stock there up about 1%. Also watching shares of Gap as well. Those are off more than 5% here. The retailer is set to cut hundreds of corporate roles in a new round of layoffs. That's according to reporting from the Wall Street Journal. This comes after the company eliminated a large number of workers this fall. Also watching industrial stocks, 3M stock here on the back of the company's earnings beat and its announcement to cut 6,000 jobs. And of course, General Electric, that stock, taking a look there, the company raised its guidance thanks to a strong outlook for its aviation division. Now, some analysts remain cautious about work that still needs to be done in GE's power division. Also tracking Raytheon, that company beat on earnings and it raised its dividend. It also said that its order backlog has reached a record. You see that the stock there almost down about 2% on the day. That's it for now. I'm Rochelle Akufo. I'll see you tomorrow at 11 a.m. Eastern.